All right, everyone, I think we will make a start. I think there'll probably be a few late joiners, but I think given that we have quite a lot to get through today, it would be good to get cracking. So thank you very much for joining this workshop on climate scenario analysis for financial institutions. And thank you very much for your general interest in the UK Pact program. Just to start off with some housekeeping before I give an introduction to myself and what we're going to be covering today. You should be automatically muted, but in the unlikely event that you aren't, please do keep your mics on mute and turn off your video when you're not speaking, just because we can occasionally run into bandwidth issues. And if you do have questions at any point in the presentation, please feel free to share those in the chat box. And they'll be attended to either as they come up, if they're appropriate for that section, or in the Q&A. The workshop is recorded, just to let you know, and it will be shared with participants afterwards. And should you experience any technical difficulties in the workshop, please do contact Sifako. His details are over there. And yeah, we're just very grateful for your time and participation in this webinar. We're sure it's going to be a successful few hours with us, so thank you for participating. Before I go through the agenda of what we're going to be covering today, I just thought it might be useful to say generally that I think in this group there is a fairly diverse range of people in terms of how much people have engaged with the content we're going to be covering today. So we've tried to pitch this workshop as an introduction, but also as sort of various levels of kind of engagement with the technical side of this topic. So please do bear that in mind. And after this workshop, we will be circulating a survey. And given that we hope to run similar trainings in the future, it would really be good to have your feedback on how this workshop went. So please do give us 2 minutes of your time when the workshop completes to fill in that survey. Now, just before I go through agenda, a very short introduction to myself. So my name is Raphael Chaskalson. I'm a senior economist at Vivid Economics. We are a strategic economics consultancy based out of London that is specialized in sustainability. And we have quite a large sustainable finance arm that has been assisting financial institutions around the world with precisely the topics that we're going to be covering today. So that includes TCFD and scenario analysis, but also portfolio baselining and target setting and Paris alignment for financial institutions as well. As far as my personal background goes, I lead on a lot of our sustainable finance for UK banks, and I've been involved in both TCFD and Paris alignment for banks and asset managers around the world. And I have a particular interest in private equity and asset management from an alignment and TCFD perspective. So that's where my specialty has taken me over the last few years, and that feeds directly into what we're going to discuss today. And I'm very privileged to be able to kind of run this workshop for you. So that's just a bit of intro to myself. In terms of what we're going to cover in the workshop, so very shortly, I'll hand over to Brent Cloete from DNA Economics, who's the consortium lead for the UK Pact project, just to give a very brief overview into the wider Pact project and what our brief is and what we're hoping to achieve through this project. I will then give a short overview into the basics of climate-related financial reporting, and this will cover key concepts like physical and transition risk, but also talk through what climate scenarios are, how they fit into TCFD reporting, and give a brief overview of where South Africa sits in this space, which some of you may have heard already if you attended some of the workshops that my colleagues from WWF and Six Capitals ran earlier this year. We'll then talk through some of the considerations in choosing off-the-shelf scenarios for a South African context. And here we're going to give an overview of the different types of scenarios that are out there and their pros and cons, and talk you through the selection process that we went through for the UK Pact project. And we'll then talk through some of the characteristics of our chosen scenario for this illustration that we're giving today, and hopefully talk through some worked examples of what the scenario outputs look like and how you can use those in reporting. Then, because we have quite a long workshop today, we've put in some time for a short break in the middle of the sessions, just so everyone can stretch their legs and catch their breath. Then after that break, we're going to talk through what I think is the most important aspect of this workshop, which is how you use these scenario outputs in practice in a transition risk analysis. And I think the key takeaway that we're trying to drive home is that the data requirements and modeling aspect of using scenarios in reporting might not be as difficult as some industry participants might fear. And so we're going to talk through 3 different approaches to how you might use scenario outputs in a transition risk analysis, and then go through very detailed worked examples of 2 of those approaches. And that section will conclude with a tentative roadmap to best practice. So the idea is that if you're an FI in South Africa starting out today, what do you need to do to get to approach 3 on that list, which is kind of in line with best practice, and how long is that going to take you? And we're going to put forward a tentative roadmap to what best practice might look like. And then finally, we'll conclude the session with a worked example of best practice. And the outputs here come from model outputs from Planetrix, who are a Vivid Economics sister company, and they specialize in the quantification of physical and transition risk for FIs. And we, for the purposes of this project, have ran an illustrative portfolio of about 50 of the largest equities on the JSE through their model. And we're going to be talking through the basics of how their model works, and then we'll go through some of those model outputs and try to draw out some general insights of what those outputs mean for South African investors from a transition risk perspective. And then finally, time permitting, we will talk through sort of some of the next steps and allow room for Q&A. Just before I hand over to Brent, just kind of 2 things to bear in mind. The first is that, as I'm sure most of you are aware, this project focuses largely exclusively on transition risk. So although as part of the project, we are producing a short write-up on some of the sources of physical risks in South Africa, how you would go about measuring it and what the data gaps are, today's workshop is focused exclusively on transition risk. So that's something to bear in mind. And just to kind of realize throughout that, obviously from a TCFD perspective, transition risk is not the full picture. The second thing that I just wanted to flag is that because we're here for, because the workshop is quite long, I'm hoping to make it as interactive as possible. So you will see throughout the workshop, there will be occasions where there'll be an opportunity to kind of answer questions interactively. We put polling questions up, and at various points in the discussion, I will ask members of the workshop to kind of offer their thoughts on a kind of open-ended question. I would encourage you to kind of participate at those junctures. I think there's no right or wrong answer in the space, and it'll be good to kind of keep this as interactive as possible. And without further ado, before we sort of crack on with the content, I'm going to hand over to Brent Cloete from DNA Economics, just to give a general overview of the UK Pact program and its aims. Over to you, Brent.
Hi, Raphael. Thank you very much for that very concise and very interesting introduction. And yeah, we'll try and keep this brief because we realized that many of you would have seen this already. So we reworked our introduction a little bit today, just to give you a bit more of a sense from what the project has done and where you can find the resources and so on. But yeah, so we'll get right into it. Raphael, you could please move on to the next slide. So thank you very much. So for those of you that are new to these webinars, UK Pact is the Partnership for Accelerated Climate Transitions. It is a UK government initiative. It's funded through the UK's International Climate Finance mechanism. Its purpose is to help developing countries achieve their nationally determined contributions, with the goal of agreeing to 2015 Paris Agreement targets. It is demand-led, so in all instances, UK Pact work with local partners and local stakeholders in order to make sure that the support offered is useful and is desired. And it's really focusing also on addressing the barriers and constraints to clean growth, and then also eventually, the main purpose of this is to increase climate ambition in order to try and prevent the dangerous climate change from occurring. If you want more information on UK Pact, there's some slides up, there's some URLs up on the screen, and that'll tell you a lot more about the project, but we'll also give you a little bit of a feel for it just over the next couple of slides. Raphael, if you could please move on. Thank you. So we're very fortunate that South Africa is one of 5 country programs being run by UK Pact. As you can see, there are also programs in China, Colombia, Malaysia, and Mexico. And in addition to the country programs, there's also another suite of UK Pact offerings, which includes a Green Recovery Challenge Fund and skill shares and secondments to help and embed the useful skills in developing countries to help them meet their climate goals. If you can please move on. Yes, so at this stage, the UK Pact has committed more than 3 million to the South Africa UK Pact country program. Roughly the funding has been split, according to stable finance, sustainable transport, and then the energy sector. The current project is part of the sustainable finance portfolio. So at this stage, 10 projects have been funded, but UK Pact is continually engaging with new partners and looking for new opportunities. Raph, if you can please move us on. Thank you. And so again, as I mentioned, all the information about UK Pact and what they're trying to achieve and the very important work they're doing in South Africa, you can find from these URLs. So yes, so please, it's well worth a look at because there's a summary of all the projects that have been funded. So it really is great work being done by UK Pact, and we're not just saying that because we're also a beneficiary, but also because we work closely with some of the other projects. We've seen the impact that they are having and will continue to have going forward. Right, so that is a quick overview of UK Pact. Raph, if you could please move us on. Now we'll give you a quick overview of the project that we're presenting here today. The project is called Aligning South Africa's Climate-Related Financial Disclosure with Global Best Practice. And what we're trying to do is to remove the barriers to the analysis and reporting of climate-related financial risks and opportunities. We're using the recommendations of the Task Force on Climate-Related Financial Disclosure as our organizing framework. We think that's the kind of right approach to take. It's a framework that's increasingly being followed internationally, and we think it's a very useful way of thinking about these issues. And the purpose of this really is to try and speed up the use of climate-related information in actually influencing investment decisions in South Africa. So this trend is already there; it's already happening. We would just like to accelerate it in order for this to happen sooner rather than later, because South Africa is particularly vulnerable to climate change, and also as a capital constrained economy, it's very important that our capital is deployed in the most effective way going forward. So, as I mentioned, there's in addition to the other UK funded projects, sorry, if you can just go back, there's also a number of other initiatives dealing with climate-related issues in South Africa at the moment. We're working very closely with those. As Raph has mentioned, we're focusing on transition risk currently, and particularly as it affects listed equities. And our main beneficiaries currently is the asset management and pension fund industries. But we are also considering physical risk in terms of what work needs to be done there, as Raphael has indicated. And the intention is to try and expand this project in future. Thanks, Raphael. If you can please move us on. So Raphael has already introduced you to vivid economics. We think that one of the strengths of our project and one of the reasons we wanted to do this project is because we think that there would be great value in bringing together best practice international models and experience that Vivid brings with the kind of deep understanding of South Africa's climate change policy and ESG landscapes that the local partners bring. And the local partners mean there's DN Economics, what most of you will hopefully be familiar with. We're an economics consulting company based in Pretoria. For more than a decade now, we've been working on climate policy in South Africa. And also we work closely with a company called The Greenhouse in Cape Town, with sustainability engineers who also have done some leading work in South Africa and understanding mitigation options available to companies, and also how that impacts on South Africa's emissions pathway, and South Africa's efforts to try and contain climate change. And then, of course, in terms of partners looking at the ESG landscape and climate more broadly, we're very fortunate to have WWF South Africa on board, who's probably one of the NGOs most visible and doing most in South Africa in order to lead the fight against climate change. So we're really glad to have them as a partner. And then also in Six Capitals, we have a partner with a long history in ESG and developing ESG in South Africa, and really is at the forefront of taking an integrated approach to ESG analysis and reporting, and making sure that it becomes a critical part of the investment analysis process. Thanks, Raph. You can please move us on. So really this project, there's three main outputs from this project. The first one you're engaging with today, which is capacity building and awareness. We've already run a series of workshops trying to create a basic level understanding of climate change and how it relates to climate risk, and particularly for the financial sector. We will also be, as part of the second main deliverable for this project, we're developing currently a toolkit that is focused on supporting the TCFD journey in South Africa. So it is really a set of useful tools to help organizations that start off, doing the TCFD journey to progress, and also to increase the quality of the disclosure. So this, there'll be a module in that toolkit that will look at scenarios specifically. So this content today will be supplemented by a guidance document for South Africa. And also the toolkit's going to have a lot of data sources, and also some other useful tools in order to get people on the journey. And then the toolkit will also form the basis for more in-depth training that will happen, during November, where we will try and take, people that are like yourself that have already, been to some of these training sessions, and build on that base knowledge to try to really move to hands-on implementation, and how you can use these tools to actually report or analyze and report in your institutions. And then lastly, as Raphael alluded to, we're very excited about the third output from the project, which is a best practice TCFD example, looking at transition risk, looking at a portfolio of 55 of the most highly invested JSE listed companies. You'll get a sneak peek of that towards the end of the session, where the projects team and the Vivid Economics team have done the analysis. So you'll get a sneak peek, but obviously there'll be a more detailed output around that that will be released in future. Thank you, Raphael. If you can please move us on. So yeah, so just to give you a sense of the 55 companies that we have looked at. Sorry, I think we've cut off the final one there, but that's not a problem. So yeah, so this as we will be circulating the slides and the recording of the session to all the participants. So no need to frantically try and write down these. You'll get this, when we circulate the content. So yes, we went for about the 55 largest companies, with a little bit of exceptions, because there were a couple of investment funds and things investment trusts and things that we dropped out, just to make sure we get a broader distribution of sectors in our analysis. But this is what the portfolio roughly looks like that Raphael will be talking about later on. So Raphael, if you can please move us on. So yeah, and then just to highlight, all the content of from this project is all freely available. It's all open source. We've created a central hub on the DNA Economics website for this project, where all the resources are being hosted. So currently we have a couple of research pieces on there, and then also importantly, we also have a number of fact sheets looking at closely aligned to the portfolio that we're analyzing. Although I think there's only one company that isn't in the fact sheets. And the fact sheets really focus on showing what people have disclosed in South Africa and where you can find that information from listed companies. So it certainly opened our eyes in terms of emphasizing that actually there's a lot more disclosure there. And even though a lot of these entities don't officially support the TCFD, they do release information that is aligned to the TCFD. So the fact sheet we found a very useful source to emphasize what's happening in South Africa, but also when you want to analyze individual companies, it's a great place to start, and it'll direct you to exactly where you can find this kind of information for the 55 largest JSE listed companies. Raf, if you can please move on.
Apologies, Brent. I think it's just frozen for a sec.
Okay, not a problem. There we go. Thank you very much, Raf. So yeah, so two of the reports that are already on there is one by Vivid Economics, where they've looked at international best practice for financial institutions. Exactly what does this mean? What are the kind of trends? It also deals with issues like scenario analysis and so forth. So that's a very useful resource. That's on on the website. The direct links are here, but you can also go through the high level link on the previous page. And then at DNA we developed a document looking at climate related financial disclosure in South Africa. So what are the current trends in South Africa? What's the rationale for it? Are there any barriers? Where's the world moving to, and so forth? So these two documents really are, is really a package. There is a little bit of duplication between the two documents, and the simple reason for that is so they can both be read as new standing documents. So you can start with whichever one you want, and then you'll find links to more detailed information on certain issues in the other document. Thank you, Raphael. If you can please move us on. And then also, as I mentioned, the foundation webinars, we've just finalized those. There are links on the website to all of these. So this also is a great resource for people just starting out the journey. So please feel free to share these with with your stakeholders or people in your institutions if you want to kind of capacitate them around these issues a little bit. This is quite a nice way of engaging with these issues. And then also the workshop recordings like this one will also be available eventually. We're still at the moment packaging them nicely. And then the toolkit information will also, and the advanced training will also be on the website once it's been concluded. And Raph, if you can please move on. So what we've also done is, through our colleagues at Capitals and WWF, we've used the Atleha-edu, which is a financial education platform, as a way of making sure that the content for this project is easily accessible and more widely distributed. So the first document that's from that platform is a very nice summary piece that looks at the two content pieces we've done, also the fact sheets and also some other sources, and pulled it together into a special edition of the Atleha-edu publication. That is, like I say, it's very accessible. It's short articles. It's easy to engage with. And we were also fortunate enough that Batseta did accredit this, this publication for CPD points. So if you are Batseta members, this is a great way to learn both a bit more about these issues, but also to get CPD points. Raphael, if you can please move us on. And then what we've also done is also on the Atleha-edu publication, we've repackaged bits of that publication into even shorter articles that's even more easier to engage with, so around specific issues. And we've also translated these articles into isiXhosa, isiZulu, Sesotho, and Tsonga. And currently the publications are up there, but also there'll also be audio pieces that that's basically the audiobook version of these publications will also be there. And then our colleagues at WWF and Six Capitals are currently working on a series of audiovisual content. So there's going to be a live action and also an animated a series of animated videos, again, which will be very short and focused. So again, it's a way of engaging with some of the stakeholders that might not be quite so clear up in terms of this progress. So if you're engaging with someone that you feel there's a bit of basic understanding at the beginning of this process missing, we think these are very good resource to get people on the on the journey. And we wanted to do that because we wanted to be we want these issues to be broadly understood and focused on in South Africa. Thank you, Raph. If you can please move on. So that's it from our side. So I'll hand back to Raphael now. If you have any questions on any of these resources or on the project, please feel free to reach out to us. There is a introductory document on the website that has all contact details on there. So yes, thank you very much for those of you that that have been to our previous webinars. Thank you very much for your continued support. And yeah, for one, I can't wait to see what Raph has to offer for us for the rest of the session. So I'm really looking forward to to the rest. Thank you, Raph.
Thank you very much, Brent. And yeah, just to emphasize again, if at any point questions come up, do throw them in the chat, and we'll either answer them at the end or as the session progresses. So what I want to start today's workshop with is just a broad overview into the topic of climate scenarios. So what are they used for, and why are they relevant to FIs in this space? And we'll start with some kind of very, I guess, basic introductory context just to kick us off. And I think the kind of remit of scenario analysis must be seen in the context with broader climate policy trends globally. And many of you will have seen that the recent report from the IPCC has essentially confirmed fears that we are in fact worse than we thought we were in terms of climate, and has made the point that there is immediate action required to prevent global warming from surpassing 1.5 degrees, and in order to meet the goals of the Paris Agreement. And what climate scenarios do is give you a sense of what states of the world, both in terms of how industrial production and the energy mix evolves, but also how kind of taxes and policy changes evolve, are compatible with these goals or not compatible with these goals. And I think maybe just kind of it's worth pointing out here right from the off that our evolution in terms of what we consider aligned with the Paris Agreement has changed and continues to change. So all of one's engagement with this topic of climate scenarios sort of needs an element of flexibility. And in fact, the IPCC, part of the recent IPCC report was to kind of make the point that in order to kind of call something fully Paris aligned, we should be aiming for a 1.5 degree world, and not necessarily a well below 2 degree world as previously thought. Now, just in terms of what the Paris Agreement is and how it relates to this work, you can see that the official wording of the Paris Agreement is to keep global warming to well below 2 degrees, sort of based on scientific advice. I won't kind of spend too long. I won't spend too long on the slide just because I'm sure sort of all of you know this context already. But just very briefly, the agreement was a global pledge by most countries in the world to limit warming to these levels. And I think the key takeaways is that to have any chance of meeting that we need to act, and we need to act quickly. And just in terms of kind of terminology and concept, the concept of kind of net zero has emerged as a kind of thematic tool when we talk about kind of closing this emissions gap. And this is achieved largely by mitigation, so the reduction of emissions, and to some extent, strategies and technologies to remove carbon from the atmosphere. And I think one of the things that the chart on the slide shows are that there are several possible pathways that the future can take, but that we require quite an ambitious one to kind of stay within the goals of the Paris Agreement, and the window to achieving that is closing relatively rapidly. Now, over the last, I'd say, kind of 5 to 10 years, there has been an increased awareness of the role financial institutions play in meeting the aims of the Paris Agreement. And I think that's largely because there has been a growing spotlight on the role that financial institutions play by financing economic activity. And financial institutions have identified several ways in which climate change both affects them and how they can contribute to the net zero transition and reducing emissions generally. So you can see on the left-hand side that there are 5 primary ways that climate change impacts financial institutions. One of them is the material impact of physical risks, so assets becoming either more risky or less valuable because of physical hazards. The other relates to kind of broader investment shifts towards green technologies and emissions reducing technologies. The middle circle that you see over there relates to intensifying regulation related to the climate. And this is largely what is the key driver of transition risk. And to a large extent, this is the key element affecting financial institutions that is relevant to what I'm going to talk about today. And then there is also an increasing sense by which investors are kind of activists on the climate and by which investors care about climate issues. And then just kind of rising public pressure and, just increased expectations of the general public to actually do something about the crisis. And financial institutions have responded to this challenge in various ways. So I think you can largely group these into kind of 4 thematic areas. Some financial institutions have both as a consequence of regulatory pressure and because of kind of internal decision-making, impose restrictions on investments in carbon-intensive sectors or the extent to which that will form a part of their future strategy. What we're seeing a lot around the world is both banks and asset managers committing to what we call Paris alignment. And broadly speaking, Paris alignment means what it says on the tin, in that it is aligning one's investment portfolio with the aims of the Paris Agreement. This is something that I and Vivid do quite a lot in. Broadly, there are kind of 3 aspects to Paris alignment. The first is baselining or footprinting the portfolio. The second is target setting. And the target setting part involves constructing some kind of Paris-aligned pathway, which I think, as we know in South Africa, is quite a challenge, although there are efforts underway to produce South African net zero pathways. And the third aspect of Paris alignment, which is really the frontier for the space, is what we would call at Vivid levers. And basically that means, okay, so now that you have your target, what can you do to meet your targets? And the various options there include engagement with customers, strategic divestments, attaching conditions to lending to make sure that lending is greener. And that space is very much in its infancy. And I think that's where the kind of frontier of this kind of climate finance work is going. Then we have a kind of burgeoning space in green investing, where the terms of issuance of certain bonds are linked to various ESG factors, and where there might be internal conditions aligned to kind of investment that are associated with green goals. And then closely linked to Paris alignment, we have kind of net zero emissions. And what we're sort of talking about today, which is transition risk and how you can use climate scenarios to take a stab at measuring it, largely kind of overlaps all four of these sectors. So this is just all four of these themes rather. So this is just to give you a kind of general theme of what the sustainable finance space is and where it's moving. And my hope is that we can kind of like talk through climate scenarios with these broad themes in mind. Now, just on some terminology, I apologize if this is kind of known to many of you. I think the key insights that you can get out of climate scenarios are narratives on physical and transition risk. And we thought just before we kind of dive into the nitty-gritty, it would be useful just being very clear on what these two things are. So physical risk refers to direct damages to owned assets, as well as indirect damages from supply chain interruptions as a result of the climate crisis. And to kind of bring this back to South Africa, areas of South Africa are going to become at much more increased risk of drought and water scarcity. And if you are invested in agriculture in those areas, your physical risk profile will increase significantly between now and 2050. So that's an example of physical risk. Another way to think about physical risk is, what happens if we do nothing? What happens if there's no mitigation or net zero transition? What are the kind of climate hazards that are going to affect the future value of your assets? And you can see that just as a kind of illustrative example of physical risk, we have a situation where a mine can't send ore to be refined because the train lines are shut down due to a wildfire, and wildfires are going to become more frequent as climate change progresses. Now, transition risk, on the other hand, is essentially what is the risk associated with your portfolio if policy action is taken to combat the climate crisis. And there are many kind of different aspects of this risk. You can see over here, there is policy and legal risk, but also the risk of technologies, of the technological mix of the energy sector and the industrial sector changing and what that means for your portfolio, and also kind of market and reputational risks associated with failure to address the climate crisis. And this is, as I said before, what we're going to be focusing on today. And you can see just one illustrative example, which we'll return to later in the workshop. The illustrative example is one of the carbon tax, and that increases costs for high carbon utilities because that's a direct cost imposed on your operations. And the classic example of a sector that is very exposed to carbon taxes is coal-fired power. Now, focusing a little bit more closely on transition risk, the introduction of kind of new climate change policies across multiple sectors will force both the reallocation of capital to mitigate transition risks and a rethinking of investment strategy. And I won't go through this in detail because there's quite a lot on the slide, but you can see some of the channels through which transition risk could affect the value of your portfolio. And I think three of the ones rather that I want to highlight over here are firstly carbon pricing, because this is very topical globally, and because direct carbon costs are perhaps the most intuitive way to think of transition risk, because it directly affects the bottom line of a business in a very measurable way. Then, very relevant to South Africa, we have the phase out of coal, which will be essential if any of the net zero goals are to be met. And then finally, I think potentially the remainder of these themes can be grouped more broadly into a theme that I would call technological shifts. And that kind of broadly means how are key technologies going to evolve in response to the climate crisis, and what does that mean for the future prospects of your business? And just as a kind of one example of why this might be relevant, if you are invested in a mine that produces nickel, you may have a significant upside from the climate crisis because nickel is a key input into electric vehicles, and demand for electric vehicles will increase as the net zero transition continues. Now, with that background, I want to kind of dive into climate scenarios, how they relate to all of this, and how we use them. So just very briefly, let's talk through kind of quickly what climate scenarios are. I think there is a bit of a tendency to kind of overcomplicate the idea of climate scenarios. All a climate scenario is some representation of the state of the world that is either consistent or not consistent with a climate-related goal. So as is in the slide, the kind of timing, magnitude, and nature of climate change and the policy moves associated with climate change is, of course, uncertain. And no matter how smart an economist you are, there's no way to kind of predict this accurately. And that's why TCFD and other best practice sort of guidelines recommend that you stress test your portfolio using a range of climate scenarios to capture this uncertainty. And as you can see over here, scenario analysis is an intuitive process for identifying and assessing the potential implications of these various states of the world. Now, there are lots of insights that you can extract from these scenarios. And just to kind of talk through some of the outputs that climate scenarios will give you, most of the time, what a scenario model will start with is some kind of assumption on temperature increases related to global warming. And that'll be used as the basis to model the drivers of both physical hazards and transition shocks. Now, you can see that in terms of how this impacts your bottom line, we've already talked through some of the physical risks that might be relevant to your portfolio, such as supply chain disruptions and disruptions to your operations and actual impairments to the asset itself, like, for instance, the risk of a building being damaged if there's increased flooding. But in terms of the kind of financial implications of what you could draw out of climate scenarios, in some cases, you can quantify what those implications are, such as in the case of a carbon price. In other cases, and this is one of the key points that I'm hoping to drive home in today's workshop, what the scenario will give you is a narrative about how the state of the world evolves and how you as an asset manager or portfolio manager respond to that narrative is actually a fundamentally subjective process and will depend quite critically on your portfolio allocation and to some extent your kind of considered view of how the world will evolve with respect to the climate crisis. And just in terms of kind of how the actual scenario models solve into kind of outputs that we can use, these vary significantly between scenarios. So sometimes you can kind of get very detailed outputs by firm or by security, or even by asset level in the case of some physical risk models. What we will be looking at today falls largely into the kind of bottom right two categories. So impacts on either the sector or the asset classes or countries and regions. And you'll see later on that the off-the-shelf scenarios that are available give you relatively good sectoral granularity, but at present don't have a South Africa specific model output. And there are various ways of getting around that problem to use the outputs meaningfully. Now, just in terms of how this relates to the TCFD recommendations, forward-looking assessments of climate risks and opportunities are essentially the point of TCFD. So this is a core element of the TCFD recommendations. And many of you will be familiar with the recommendations. So you can see that there are four key themes. There is governance. So this frames how an organization's governance should be structured to oversee responses to climate-related risks and opportunities. There is strategy. So this measures the impacts of climate-related risks and opportunities on the organization's business to inform future strategy. Then there is risk management. So that's essentially, now that you have a considered idea of those risks, how do you manage those risks? And then finally, there's metrics and targets, which involves things like portfolio baselining and target setting relating directly to the Paris alignment work that I gave a brief overview of earlier in the workshop. And I think today's workshop focuses largely on the strategy part. So how do you kind of identify the physical and transition risks, or in this case, transition risks that you're facing, and how can we make the most of what is publicly available to get a sense of what those risks are, even if there isn't large budget to kind of employ sophisticated modeling externally or the capacity to do that internally. And I won't spend kind of too much longer on the TCFD recommendations, but just broadly speaking, this slide gives an overview into kind of some of the steps that can be taken to meet the four themes. And I think I just want to kind of focus very kind of briefly on the strategy aspects of this recommendation. So you can see that the first step to a TCFD disclosure is to describe the climate-related risks and opportunities the organization has identified over the short and long term. And I want to emphasize the descriptive nature of this step. I do so to kind of stress the point that what the TCFD is asking for is not actually particularly kind of sophisticated or granular. To be TCFD compliant, what you have to be able to kind of give in a disclosure is a narrative of where your portfolio or business is likely to be impacted in terms of risks and opportunities related to the climate. And then it's kind of describing the impact of those risks and opportunities and how those relate to your future strategy. Now, I did warn everyone that this workshop is going to be as interactive as possible. And over the course of the workshop, we're going to put on some poll questions to kind of get participant views. And bearing in mind what I've just shown you on the TCFD recommendation, I'll just move back to the slide just in case, just so you have it. We're going to take a minute now. You should be able to respond to this poll. And I'd like you to answer which of the 4 recommendations are the most challenging for your business. It would be very interesting to kind of get a sense of your view in this. So I'll give participants a minute to answer this, and then we'll crack on. All right, Sefako, can we sort of display answers to participants? So I unfortunately can't see from presenter view, but I'm assuming you can see the responses. So I think these results are very interesting. I think overwhelmingly for people that did respond, the metrics and targets section is the most challenging aspect of the TCFD recommendation. And I'm going to hazard a guess that the reason why that section of it is difficult relates partly to the availability of data to construct metrics such as portfolio baselines, and also kind of methodological knowledge and expertise for conducting those baselines and also for target setting. And one of the things that we are hoping to kind of show through this workshop is that certainly from a transition risk perspective, there is actually quite a lot that can be done with off-the-shelf data and relatively intuitive and minimal modeling capacity. So I think that result is to some extent expected, but also feeds directly into what we're doing today. I do think what's interesting in terms of the responses is that nobody answered the risk management category. And I think that is probably either because, well, I mean, obviously it means that sort of there isn't a sense that kind of transition and physical risks are a kind of big deal to manage internally. But I guess one of the points is that I see the kind of risk management and strategy as fundamentally interlinked as far as the TCFD recommendation goes. And hopefully you'll see when we produce the TCFD disclosure as part of this work that following on from disclosing what your climate risks are, the next step is to kind of articulate a strategy for managing those risks. Now, just moving on, what I wanted to kind of show in this slide is just the kind of flavor of the type of variables you can extract from climate scenarios. And this is going to be a key aspect of this workshop. So looking at how the scenario outputs work in practice and how we can use them. And as I said before, what scenarios do is construct narratives of climate change risk and ensure consistency across assumptions. And you can see on the left-hand side, there are a couple of variables that you can get off the shelf from these scenarios, which can directly inform this analysis. And I won't go through all of them, but 2 of them that I want to focus on, which we will come back to later, are future trajectories of carbon prices, which can lead to kind of direct quantification of carbon costs on your business or your portfolio, and kind of outputs of how the energy mix will evolve over time. And we'll see later on that these are particularly useful. These are particularly useful aspects of climate scenarios that you can use. I've just seen a comment from Dave Collins on the chat, and I'm just going to read it out in case anybody didn't hear. So the comment is, in spite of all the attention about net zero 2050 and 1.5 degrees, the TCFD still only talks about 2 degrees or lower. And thanks, Dave. I think that's a really valuable point. I think there are 2. We're going to come back to this later on in the session, but just kind of very briefly, I think there are 2 reasons for this. I think the first is that the kind of IPCC's rethink of this is relatively recent, and to some extent, the TCFD recommendations. The TCFD recommendations are older than that report and to some extent need updating. But I think more generally, one of the kind of points that we're hoping to drive home in this session is that within the TCFD framework, it is acceptable and indeed encouraged to include a range of policy ambition in what you use for stress testing. And so what we have done through this project and what we would recommend participants do is use a 1.5 degree compliance scenario and potentially a below 2 degree compliance scenario as separate stress testing kind of metrics in your TCFD disclosure, so that a range of possible policy ambition is covered in your risk assessment. Now just to kind of wrap up the introductory content. The results of the scenario outputs can be used to identify risks and opportunities related to climate, but also to foster engagement with investees. But with this in mind, I do want to kind of stress some of the limitations of these methods. I think that scenario analysis can give very good insights into key variables, largely related to the kind of energy and technology system. And particularly, we'll find kind of later in the workshop that what I think off-the-shelf scenarios are very good at are exploring the impacts of different decarbonization pathways under a range of plausible scenarios. But there are important limitations. There are important limitations to this. I think to kind of state the obvious, what a climate scenario is not going to do is accurately forecast the future. All it does is give you what is a kind of reasonable set of kind of policy circumstances consistent with a given climate ambition. And with that in mind, the quantitative outputs from the scenario should be used with caution and should really only just be used to kind of give an order of magnitude assessment rather than a very precise quantification of transitional physical risk. I should also add over here, as I've mentioned already, that of course there are no kind of internally consistent net zero pathways for South Africa off the shelf yet, although we do know that these are in development and will prove useful. So that is obviously a kind of key limitation of using off the shelf outputs to a South African portfolio. On the other hand, one of the things that we are going to emphasize is that partly because South African firms are price takers in global markets and large companies have large exposure to kind of global operations, there is still significant value in using a globally oriented or even a regionally oriented scenario to stress test transition risk. And indeed, the TCFD recommendations, first and foremost, want people to get started with this. So we certainly wouldn't take the line that, that the absence of such outputs for South Africa is a reason to wait. If anything, it's more of a reason to get started, so that FIs can kind of get started on the journey. Now, what I want to do over here, and this is where I'm going to encourage you to kind of raise your hands and participate. Dave, I'll come back to that question a little bit later at the end of the session, if that's okay. And now, just to kind of give you a flavor of what's to come later in the workshop, I want to talk through a kind of very short worked example of what the kind of scenario outputs look like. And I'm going to kind of share. I'm going to show my screen over here, and I'm going to encourage people to kind of voice their opinions on this. This is an example of some of the outputs that you can extract from an off-the-shelf scenario. And what I'm showing over here is one of the NGFS below 2 degree scenarios, and the outputs are global. So these are not South Africa or Africa related. These are global, these are kind of global outputs. But this background context is kind of irrelevant for this exercise. What I'm hoping to kind of get a sense of from participants is what kind of overall takeaways do you think we can infer from what you see on the screen over here, in terms of how this would affect a portfolio from a transition risk perspective? And just to kind of talk through some of the narrative that you can extract from this. On the left-hand side, we have an example of how the global carbon price might evolve. And you can see that from about kind of 2035, there is quite a significant increase in the global carbon price, peaking at about kind of $200 per ton of carbon dioxide. And what I'd like you to do is just for kind of a minute, think through, if you are invested in a global portfolio, I see from Dave, we have get out of coal. but maybe kind of think through, how do you think this is going to impact your bottom line as an investor, assuming that you have global exposure? And then on the right-hand side, we have sort of evolution of the energy mix. And you can see two kind of very clear trends from this is coal being phased out and renewables being phased in. And maybe I'm sort of going to try, I'm going to try kind of like let participants answer. I'd like you to kind of think a little bit about, from a transition risk perspective, what do these two trends mean? And if you have kind of thoughts to sort of share with the group, please raise your hand. And when I open it up to responses, Sifako, if you could unmute kind of people that raise their hand just to kind of give thoughts, that would be great. So I'll give people a minute to kind of think on this, and then I will hopefully take responses. And as I said before, sort of don't be shy. Please do sort of get involved and voice your views on this. There isn't a right answer. This is very portfolio dependent. Thank you, Maria. I see you responded on the chat. I think just for the purposes of keeping this interactive, it would be nice to kind of sort of have participants talk. So if you could raise your hand on the chat, potentially if you also have kind of any views on this, we can sort of open this up to the floor. I'm not seeing any hands, so I'm very sorry, Maria. I might put you on the spot. I'm gonna read out your response, and then if you, I'd be very interested in kind of hearing further thoughts on this. So we have that these outputs can be used from when projecting financial statements of a company into the future, given price movements and portfolio combinations. Maria, I wonder if, no worries if you don't feel comfortable, but it would be useful to kind of hear some further thoughts on this, just to kind of explain a little bit more what you mean. So for instance, how do you think these outputs could say, impact a portfolio allocation? How would you kind of use these outputs to sort of infer, how your kind of medium and long-term strategy? And Dave, I have seen your hand. I'll sort of come to you next.
Thanks, Raphael. I wasn't looking to speak, but hey. Okay. So the way I see it is, this, if you were to present something like this to the decision makers, this information will definitely, start driving, because remember, decision makers really care about bottom line. And if you're seeing that the cost of global carbon price will be going up, you actually may, this will impact the strategy in the sense that, investment or if there's any direct investment that the company has in carbon footprinted investments, that might reduce, so that the cost, the impact of this cost does not come in. So this will definitely impact the way the portfolios are structured, and and it can be further used as an input into the valuation model the companies use, given their dynamics of the portfolios that they intend to. So there's absolute value there.
I think, Dave, you're unmuted now.
Yeah, but you were muted. So.
Oh, sorry.
Yeah, Raphael, I think the right-hand one is going to happen probably largely because of technology costs, but the left-hand one, of course, is going to make it even more dramatic. It's going to accelerate the right-hand one. And I guess we often talk about risks. We always talk about risks, but we never maybe pay as much opportunity, as much attention as we should to opportunities. And just think what that carbon price will do to things like green hydrogen, steel making with green hydrogen, all that kind of thing. So I guess companies mustn't just focus on risks. They really must start thinking about opportunities, which is actually more difficult in a way.
No, absolutely. I think that's a very valuable point. Certainly kind of certainly there are kind of two sides to the TCFD framework, kind of risks and opportunities. I think another point that you alluded to, Dave, which is very important to keep in mind, is that part of the nature of these climate risks are that they shouldn't be assessed kind of separately to one another. And indeed, you pointed out kind of, very insightfully that these two affect each other. So to some extent, the carbon price is, what we would say endogenous to the energy mix and vice versa. And so kind of when using these scenario outputs, there is a kind of strong argument to kind of consider the narrative holistically rather than in isolation. Thank you both very much for sort of offering thoughts on that. I'm going to kind of ask for kind of participation as we go, but that was very, very insightful. Thank you. So I think most of these, you know, most of the points that kind of we put underneath are covered, but just to kind of draw out a few things that we can get from the narratives on the slide. I think one important point to bear in mind about carbon prices, one important point, and Gugu, I have seen your question, so I will respond after I make this point. One of the important points to bear in mind about carbon prices from scenario outputs is what the scenario gives you is a real carbon price. So it is a weighted average of different kind of carbon taxes, such as you know, ETS caps or border adjustments and other ways that you can tax carbon, and that's so you can kind of apply it directly to the bottom line. And a kind of another point related to carbon prices is that both the absolute price and the rate of change is important. And the reason the rate of change is important is that, as we'll see later, in delayed scenarios, often you'll end up finding a very steep increase in the carbon price at, say, 2035 or 2040. And that steep increase can be very disruptive rather than something that's a little bit more gradual. And just to kind of move quickly onto the energy mix, there obviously kind of increased kind of phase out of coal combined with carbon costs will kind of drive destruction of things like, you know, coal-fired power plants. But as Dave kind of rightly pointed out, there are also kind of significant opportunities associated with renewable energy. And what climate scenarios give you is some kind of assessment of how significant those opportunities are for your business, and how a strategic reallocation to those kind of industries might offset some of the losses that you would get from other sources of transition risk. I've just seen a question from Google, so I'm just going to read it out to the group. For the oil industry, would the reduced efficiency of oil machinery due to temperatures from climate changes be considered a transition risk? The answer is no, that's a physical risk. And the reason it's a physical risk is because higher temperatures are a kind of consequence of climate change. And, you know, extreme temperatures will be a consequence of us kind of doing nothing, of there being kind of no policy, action. What I think would be, I guess, a sort of flip side of that example, which would be transition risk, is if the government imposed a tax on machinery that is used in oil refining, that would make production more expensive and kind of force people out of the sector, and that would be a transition risk. But thank you. I think it's good. That's a good question, and it's good that we've clarified that. Just kind of in general, transition risk is, physical risk is what happens if we do nothing, and transition risk is what happens if kind of policy and technologies change in response to the climate crisis. I think before I move on, I just want to check, are there any other kind of initial questions or reflections on this section? All right, it looks like we can move on. So what I want to do now is just kind of give a very brief flavor of how kind of some stakeholders in South Africa have used outputs from climate scenarios in their disclosures. And I'm not going to spend too long on this because I think many of you will have attended the workshops that my colleagues at WWF and 6 Capital gave. But what I want to do over here is just focus on how two of the largest FIs in South Africa, ABSA and Nedbank, have used scenario analysis in their disclosure. And I think this summary table kind of gives you a flavor of what they've done and how they've used scenario outputs. You can see in the case of ABSA, the primary motivation for scenario analysis is physical risk and not transition risk. Whereas in the case of Nedbank, the motivation for using climate scenarios is restricted to their high emission sectors, but it is to kind of measure alignment with the Paris-aligned pathway more generally. Now, kind of moving on to the next question, whether these FIs have actually used scenarios to kind of quantify the extent of their risk. The overall answer is no, but there are kind of some proofs of concepts that they've used in their disclosures. So ABSA have, for a kind of small section of their agriculture book, tried to quantify the impact of physical risk. I think it's for their farms in the Free State that they've done this, under 2 of the IPCC scenarios. And in the case of Nedbank, they haven't quantified transition risk, but they have used the PACTA tool, which I'll talk about in a sec, to kind of get a sense of what portfolio alignment would look like for them. And you can see that both of these bodies have used some kind of qualitative assessment of physical and transition risk. And both of them are also planning to kind of extend this analysis into kind of future disclosures. Now, just kind of focusing on the transition risk aspect, I think what's kind of interesting about this is that the industry understanding of transition risk and what it means is a little bit fluid at the moment and is evolving. So both of these bodies have sort of slightly different definitions of transition risks and assessments rather of how these apply to their operations. And I won't kind of read all of this in detail, but I think what is quite interesting is that ABSA have taken an initial stab at sort of quantifying how much South Africa's carbon taxes will impact their bottom line. I am happy for kind of my colleagues to correct me on this because I don't know their disclosure as well as they do, but my understanding is that is only looking at their own operations. So it's not looking at the companies that they finance. It's just looking at, you know, ABSA's buildings and everything they need to run their businesses. How much will the carbon tax impact their bottom line? Now, just to kind of give a little bit more detail into kind of what ABSA's done. So most of their detailed work on scenario analysis focuses on physical risk and is restricted to a proof of concept on the agriculture sector. And yeah, Brent has just kind of pointed out that that I was correct. It's just for operations. So what they've done is they have assessed how vulnerable a portion of their agriculture portfolio is to drought as a consequence of extreme heating. And they've restricted this to the impact of climate change on the maize harvest in the Free State by 2050. Now, this pilot has actually the analysis is quite insightful and it's been largely successful. So they'll expand this to kind of remaining agriculture sectors and their real estate portfolio during the course of this year. So that should be in their next disclosure. Now, what they've done more generally in their portfolio is they have given a qualitative assessment of how climate sensitive their other sectors are. And these assessments are largely using off-the-shelf sources. So this comes from a UN document that kind of gives a qualitative ranking of how climate exposed various sectors in an investment portfolio may be. And I think it's worth showing this just to kind of point out that what ABSA has done in its TCFD disclosure is actually a kind of very good start and is still in line with the TCFD recommendations. And so I think it's just worth emphasizing, and I'm going to say this again and again, that to produce something in line with the TCFD, the starting point for doing so does not necessarily need to be kind of particularly sophisticated or detailed. And indeed, all ABSA have done is essentially kind of lifted something from a UN report and reported their exposures to the climate sensitive sectors. Now, those exposures don't discuss physical and transition risk separately, but it is nonetheless a very good overview of how they might think about kind of portfolio reallocations in the future. Now, Lorena's given a question of where the results of ABSA's pilot scenario analysis are disclosed. Brent, I might need your help with this one. I'm not sure if this is kind of only internal to the bank. They've certainly done it, but I don't know if they've kind of published something separate on that disclosure. So I think I'll ask kind of some of my colleagues to kind of respond in chat to that. Now, in terms of Brent, I see you've unmuted yourself. Sorry, do you want to quickly give a? No,
I was just saying we might have to check with our WWF colleagues for that. I mean, I know the graph on the right is definitely in their TCFD report. I'm not sure about the results from the scenario analysis. That might have been through engagement with WWF. So we'll just have to check on that.
Yeah. Then just kind of moving quickly on to kind of what Nedbank has done. I won't spend too much time on this just because I'm a bit conscious we have quite a lot to get through in this workshop. But they've essentially used the Pacta tool, which is an off-the-shelf tool for FIs, to do what is essentially a kind of proof of concept Paris alignment exercise. So to align their kind of power generation and upstream fossil fuel investments with a Paris aligned pathway that comes out of the Pacta tool. This too is a very kind of good start to this exercise. I will say though that the Pacta tool is limited in the sense that it offers kind of pathways associated with individual companies and assets, but the coverage that you get from it is relatively limited and quite restricted to emissions intensive sectors. So this is a kind of very good thing to include in the disclosure, but is not something that gives you an overall Paris aligned set of pathways for the portfolio, or indeed an overall assessment of physical and transition risk to the portfolio. You can see that what they've done is a more high level kind of qualitative overview of the drivers of physical and transition risk, and there's a little bit kind of cut off at the bottom. You can view this in their disclosure with some kind of initial views on kind of how this affects their internal assessment of climate risk. Now, just to kind of briefly conclude this introductory section, I think the key takeaway from what we've seen so far is that scenario analysis for FIs isn't kind of comprehensively being used yet in South Africa for disclosures. There's been kind of relatively piecemeal uptake from FIs and corporates. Some of the big retailers, I think ShopRite have certainly done a TCFD report and might have engaged with this a little bit. But the application to kind of transition risk specifically is largely related to kind of proofs of concepts and kind of qualitative overviews rather than a kind of more detailed assessment of how it affects the portfolio. So that's the lay of the land. On the other hand, I think one of the other takeaways that we get from this is that the fact that local pathways for South Africa don't yet exist are most certainly not an insurmountable barrier to meaningful analysis in this space, or indeed to kind of getting started with disclosures based on scenario analysis. One reason for that is that most major corporates in South Africa have some kind of global operations. So that already gives sort of like persuasive reasoning for why a global scenario or a regional, say Africa specific scenario might be useful. But also just kind of generally, there's a kind of key takeaway that it's possible to produce meaningful and indeed TCFD compliant disclosures based on largely off-the-shelf outputs. And if you wanted to kind of ask me what kind of best practice in the space is, it would be to kind of get started rather than to wait. And I think, as we'll see later on, there is significant scope to get started with off-the-shelf outputs in scenario analysis. Now, if it's okay, I'm going to sort of press on to the next section, just because I think the sort of fourth and fifth sections after the break are what I'd like to spend the most time on. So I'm going to crack on to section 2, if everyone's okay with that. Sorry, section 3 rather. And I'll keep this a little bit more brief. What I want to do, in light of what I've just discussed, is talk through knowing what the limitations are of kind of global scenarios, and knowing kind of where the lay of the land is in terms of what people are reporting. I want to talk through some of the things that you might consider when choosing a scenario for the South African context. And indeed, through this process, we're also going to talk through the process that we went through in choosing scenarios for this stress testing exercise, and explain why we did it and what the limitations of that analysis are. Now, just to kind of keep everybody on their toes, I've got another kind of poll that I'd like everybody to sort of participate in. So Sifako, if you could show it, that would be great. And the question over here is, what I've listed over here are essentially kind of 4 key trends that you can extract from climate scenarios using off-the-shelf outputs. And what I would like you to consider is, which aspect of the green transition do you think will have the greatest impact on your risk portfolio, or the profit margins of your business if you're a corporate rather than an FI? And I'm going to give people a minute to respond to this. So please do kind of give your thoughts on the questions, and we'll return to kind of participant responses in a bit. We've got quite a few replies coming in. I'll give just another 30 seconds, and then then we can look through. Right. So, Sifako, can you just make sure participants can see the results? I think they probably can. There we go. It looks like these have been shared. So thanks for responding. We have a relatively even mix of the first three. So it's interesting that sort of most participants don't consider land use changes a kind of key driver of transition risk. And I guess that's probably because most of you sort of either aren't invested in agriculture or don't see this as a kind of major feature of the South African sort of agricultural landscape. We have a relatively even mix of sort of carbon taxes, changes in the energy mix, and investment in green technologies. And I think the sort of last of these, investment in green technologies, is an interesting one, because as Dave had pointed out before, that's a little bit of a double-edged sword, in that it both drives the transition away from carbon-intensive sectors, but also is a driver of key opportunities in that space as well. So thank you for participating in that poll. Now, I just want to kind of talk through a kind of basic kind of framework for sort of how you go about, choosing climate scenarios for reporting. And there are kind of there's sort of three key steps that there are to take. The first is to choose a high-level scenario provider. And there are several kind of off-the-shelf providers of climate scenarios that you can use. You'll see later in the presentation that we're using the NGFS scenarios, but there are others that may be more appropriate to your portfolio. The second is, within the actual scenarios, what you'll find is that there are many different kind of models or sub-scenarios, each of which rely on different assumptions about kind of the way the state of the world will evolve. And you'll see over here that what we're using of the NGFS suite is the Remind Magpie model, and I'll talk through why in a bit. And then finally, once you've chosen your overall model, it's to choose the actual scenarios that you use in the stress testing exercise, because often there'll be several outputs of that model, each with different policy assumptions. Now, this is just to kind of talk through why we ended up using the NGFS scenarios for this exercise. And we basically kind of screened them on three core criteria. The first is kind of a general criteria for whether they're kind of largely adopted in transition risk stress testing. And that allowed us to kind of filter out quite a lot of the other off-the-shelf scenarios that are available. I think the second set of criteria, which are kind of largely technical, are whether there is a kind of suitable range of policy ambition represented in the scenario outputs. And what we were specifically kind of trying to get over here is a range of policy ambition that includes at least one Paris-aligned scenario, so 1.5 degree compliant, but also a realistic range of, say, well below 2 degree scenarios and BAU scenarios that allow a kind of comparison of options. And finally, we applied a third screening metrics, which is how relevant and widely used are these in the financial sector. And after going through this exercise, we settled on the NGFS scenarios because they are by far the most used for this kind of stress testing in the financial sector. And also specifically in South Africa, SARB has signed up to NGFS, and this was kind of the broad process that we followed. Now, just to kind of give you a flavor of what the NGFS suite sort of gives you, the NGFS scenarios are an example of what we call integrated assessment models. And all IAMs really are essentially an economy-wide model that incorporates climate aspects and the energy system, as well as socioeconomic variables like GDP and population. And what they kind of give as an output are kind of three suites of models: GCAM, Message, Globium, and Remind, to model climate scenarios. You can see that there is quite a wide range of policy ambition that is extracted from these outputs, and we'll talk through kind of which of them we actually chose. And sorry, I'm just kind of responding to the message on the chat. Lorena, thanks for the comment. I think what I meant was, I think APSA had kind of reported that the pilot was successful and that they'll be rolling it out. My apologies if I kind of sort of implied that was available. I think I'll defer to Sarah on this if it's not public knowledge. Now, just a kind of, I've given a sort of brief overview of these, but just a quick intro into kind of what these IMs do. Really, this isn't kind of that important for our purposes, but they're essentially climate-wide models that also incorporate socioeconomic aspects and assumptions over how key macroeconomic variables will evolve. Now, what the NGFS climate scenarios offer are a framework and set of scenarios to explore physical and transition risk. And I think the kind of fundamental distinction that NGFS makes, which I think is quite useful for financial institutions, is the distinction between orderly and disorderly transitions. And broadly speaking, what that distinction refers to is whether the transition to, say, rising carbon taxes or green technologies happens gradually, or whether it happens suddenly at a later date. And what we will see later is that from the point of view of long-term transition risk, delayed action, so the disorderly transitions, will result in a much larger impairment on the bottom line of kind of businesses and financial institutions when we talk through the Planetrix results right at the end of this workshop. Now, just in terms of what we're actually using for the purposes of the PACT project, the NGFS scenario outputs allow you to kind of explore states of the world consistent with warming to well below 2 degrees, as well as a so-called hothouse world, which is essentially a continuation of current policies with severe physical risks. And as I'll show kind of later, we are actually also including a 1.5 degree compliance scenario as well in this analysis from the NGFS to present the full range of policy ambition. Now, this is just a kind of, a sort of a kind of framework for kind of the different options that NGFS gives you. So I won't spend too long on this, but you can see that the key driver of the NGFS models that we are using are kind of changes in the energy system and policies associated with those changes. And we are using a particular subspecies of model called the Remind model. And I'll talk through in a second why we chose that model over the other model outputs. And then within those outputs, we are using a proxy for current policies, a below 2 degree scenario, and a net zero 2050 scenario. And those scenarios will give you will kind of give you a series of outputs that are kind of circumscribed between kind of now and 2050, and will give you kind of carbon price trajectories principally at the regional level. What you'll see later on, and I'll talk about this in about 5 minutes, is that as part of this project, the one variable that we have customized to the South African context is the carbon price forecast. And just one final point on this before I talk about why we chose the Remind model. The NGFS outputs allow you to kind of use either global scenarios or Africa-specific outputs. They don't yet have a South Africa. They don't yet have kind of country-specific outputs. Now, just in terms of why we went for the Remind model, I think there's quite a lot of detail on the slide, and I'm not going to spend too long on it. But I think one of the key points in choosing sub-scenarios is that the models themselves apply a kind of set of internally consistent assumptions. And for the scenario analysis to be meaningful, it makes the most sense to kind of restrict your scenarios to outputs from one particular model. And we decided to go for the Remind model for two main reasons. I think the first reason is that we think that the Remind model offers the most realistic representation of how the South African energy mix is likely to evolve in the long term. And I want to caveat this very heavily in that we, of course, know incredibly little about how the South African energy mix will evolve. And the fact that sort of Eskom is such a big player in South Africa and the sort of political dynamics associated with that does make predicting anything in this space quite complicated. But nonetheless, we think there are some aspects of the alternative models that are less likely to be aligned to South Africa. In terms of kind of message globium, that particular kind of subspecies of model relies very heavily on CCS and negative emissions technologies, which for various reasons, and I'm happy to let kind of Brent or my colleagues at the Greenhouse kind of opine on this further, we don't think is very realistic for South Africa. And then finally, kind of the GCAM model relies very heavily on increased uptake of nuclear energy, which we think is certainly, in terms of what the IRP in South Africa is saying, probably not going to be the basis of the decarbonization strategy. And just in terms of kind of why Remind might be superior to these two options, it assumes increased reliance on renewable energy, and the costs of technology of renewables are kind of slightly more optimistic than the other models, and there is some kind of reliance on biomass and nuclear still included. Now, just in terms of kind of Dave's comment, he's making the point that we certainly have an idea of where the energy mix has to go. I think that's right. I think we do have a fairly good idea of how the energy mix must evolve for the net zero transition. I think why we're trying to kind of map this to kind of where it's rather likely to go within kind of like those constraints is precisely because I think the scenario outputs need to give you at least a kind of vaguely realistic representation of kind of states of the world in different kind of policy scenarios. And I just want to kind of, I really kind of want to stress here, I can't kind of stress this enough, that what we're after over here in terms of using these scenarios is not precision. I think what we want is a kind of realistic set of policy scenarios that allow you as a portfolio manager to kind of stress test a range of circumstances on your portfolio. So what you need is something that is broadly sensible and defensible. You don't need something that is entirely accurate for a scenario to be the most useful. And just kind of going into a little bit more detail, I won't kind of focus on this a lot, but I think what we do know about South Africa's kind of stated ambition for its energy mix for 2030 aligns most closely to the kind of Remind assumptions, much more than it does the other scenarios. And just a kind of quick question from Maria in terms of whether the GCAM model output allows users to input the rate of low carbon uptake. The model will allow you to select a range of uptakes of key technologies. I think why we were a bit hesitant to use that model is that it is incredibly optimistic on CCS technology, so specifically negative emissions technology rather than low carbon technology. And there are various reasons why we think the Remind model is a better option for South Africa. Yeah, okay, and I see Brent, Brent has kind of offered some more thoughts on this as well. Now, this is just a summary of the scenarios that we're actually using in the stress testing analysis. You can see that our kind of hothouse world scenario is our proxy for current policies. Our immediate 2 degrees with CDR is a kind of quasi-Paris aligned scenario that has some uptake of negative emissions technologies, and our most optimistic one is the immediate 1.5 degree scenario. Our choice for the kind of disorderly transition is the delayed 2 degree scenario with limited CDR. And as we'll see in a second, this delayed transition will result in much higher carbon prices and a much more disruptive transition. And these are just the kind of key characteristics of what these scenarios are. Brent, I see your hands up, so I'm going to unmute you. Just give me 1 sec. Sefako, I think I might need you to do this. I'm not sure if I have this power.
Don't worry, I think I'm unmuted.
Yeah, there you go.
Okay, cool, thank you. Now, Raf, sorry, I just wanted to quickly come in there just to highlight when we were chatting to stakeholders previously, the CDR thing is slightly confuses people. I thought it might just be useful to just flag what that means. So the carbon dioxide removal.
Sorry, Brent, I accidentally muted you. I was trying to mute myself. Can you unmute him, Sefako? Thank you.
Not a problem. I think I'm unmuted again, Raphael.
Okay, sure. Sorry about that.
Yeah. So if you could just flip back, to the previous slide, please, if you don't mind, Raphael. Cool. So yeah, so the carbon dioxide removal, again, it's CDR is, includes technologies like, like CCS and so forth. So there is a little bit in there, but so there's a technical explanation of what CDR is. But really, the way that is useful for me is CDR almost is, an indication of your belief in technology and whether you think technology assumptions are going to be positive or positive or negative going forward. So really, whether you think the current technology assumptions are optimistic or pessimistic. So if you think they're optimistic and technologies will improve, then with CDR is a good proxy for that. Although it's not technically correct, but it's a useful way of thinking about that. But limited CDR just basically means we're going to have to do much more of the mitigation through technologies at the firm at the firm level and in the production process. So limited CDR again just means if we end up with we start late and then the assumptions of mitigation don't end up being as great as we expected, then it's a bit more of an impact. So don't get too hung up about CDR. There is a technical explanation for it, but on this hand, really, it's another way of tweaking the scenarios in order to create a range of outcomes. So limited CDR gets you into the kind of more negative outcomes. It just helps to broaden the range of scenarios in terms of outcomes. Sorry, I hope that was useful, and I'll stop interrupting you now, Raf.
No, absolutely, Brent. That was a very good point, and thank you. Thank you very much for raising that. I think that was an important clarification. I think just to sort of sum up and just to sum up the kind of key takeaways of the scenarios that we chose. I think I've mentioned this already, but obviously what the IPCC is saying now is that 1.5 degree goals are what we should think about when talking about Paris alignment. We have included one of those, but we continue to include the other scenarios in our analysis, just so we present a kind of suitably realistic range of policy ambition. I think the other point which I kind of want to sort of flag here is that there is the kind of difference between a 1.5 or 2 degree pathway in terms of what it means for transition risk. While it might not sound like a lot in terms of warming, is actually kind of very significant. And there is a much more ambitious set of policies required to be 1.5 degree compliant than there is to kind of be well below 2 degrees. And then just to kind of reemphasize the kind of the value of doing this. The value of doing this is enhanced by kind of assessing a totality of kind of scenarios and outputs rather than in isolation. And that kind of goes back to the kind of initial point that I made about considering the outputs of these scenarios in conjunction with each other rather than in isolation. Now, I don't want to kind of spend too long on this, but I do want to kind of also show that one aspect of the UK Pact project that is South Africa specific has been a modeling exercise to kind of forecast local carbon prices. Now, this is a kind of input into the modeling exercise only insofar as we quantify direct carbon costs. The carbon price is not an overall proxy for transition risk, but it does get you a kind of relatively good indication of direct carbon costs on emissions intensive businesses. And when we kind of do the Planetrics exercise, this model price is applied to the local operations of JSE listed companies, so not their global operations. Now, I want to be kind of very clear on what the limitations of this are. We are not kind of assuming that the carbon price kind of influences sort of company behavior perhaps as much as it should have. This is largely just because of the limitations of the modeling exercise. And there is a key underlying assumption, certainly in the Planetrics work, that South African companies follow global trends in technology uptake. And that is an important limitation, but that's because both in terms of our modeling capacity and also information out there, how those trends will kind of evolve locally is very uncertain. But also kind of just more generally, for kind of bespoke model carbon prices to be useful, they don't have to be entirely accurate, but they must be reasonable. And so what we've tried to do is use as much information as we can on the South African energy mix and its current kind of carbon pricing policy to forecast what we think is a reasonable range of carbon prices under different scenarios. And our starting point for this has been kind of what we know about the South African energy mix. And it'll be no surprises to many of you that we actually don't know very much about it. And there isn't kind of that much forthcoming from government in terms of information on this. The most recent NDC update provides us kind of with only 2 data points to kind of forecast what the energy mix might look like. And unfortunately, it doesn't kind of provide us with any significant insights over and above the IRP in terms of how the energy mix will evolve to meet those goals. So what we have kind of included on the right is a very hypothetical, and I stress very hypothetical, shape of what a kind of trajectory for South Africa to net zero only in terms of the energy mix might look like. And this is not an official position, but the shape of this graph is to some extent a starting point for how we modeled the carbon prices. And thank you, Dave. You've actually kind of pointed out that we might be using sort of slightly old figures in this, but it won't kind of affect the sort of key takeaways of the analysis significantly at all. What I'm going to talk through now is just sort of some of the assumptions that we use to kind of forecast the carbon price. If possible, I'd like to kind of not get too hung up on this because it's not a key input into the analysis. But I just want to kind of give everybody a sort of overview of how we've done it. So the pathway for current policies is based largely on the kind of 2021 tax rate and what we know about it. And this, from a modeling perspective, we haven't done very much here. The allowances and differentials between sectors remain the same after kind of phase 2. And that is kind of what we're using in our kind of hothouse world assumption. And you can see that you can see that even kind of compared to the sort of global carbon price under NGFS, the South African one in dollar terms will be significantly lower under this scenario. Now, in terms of the immediate 2-degree transition scenario, as you'll see with all the other modeled carbon prices that we have, because we assume kind of technology price taking and South Africa being a price taking global markets, all of the other scenarios have an underlying assumption of convergence with global prices embedded in them. And this is quite important for how we kind of go about quantifying transition risks in the Planetrix model and elsewhere as well. And you can see for the immediate 2-degree transition, some of the assumptions that we made, which is kind of a 5% real increase until 2027, and then a linear increase that comes from some of our work in the inevitable policy response, which Vivid Economics also did and it kind of applied to South Africa, and a gradual reduction in allowances that vary within the different sectors. But you can see in kind of macro terms, the difference between kind of the sectoral carbon prices starts to kind of become insignificant as we go. And the process that we followed for the immediate transition is similar, just a little bit more ambitious. You can see that the kind of linear increase after 2028 is using kind of a bigger step at $50. And you can see that there's a kind of gradually a bit of a quicker kind of phase out of these allowances. And you can see that in the delayed transition, what we've essentially done is kind of model the changes sort of relative to the current policies pathway. And all we've done is kind of assumed a linear increase to kind of match the international carbon price by 2031, after 2031. One of the kind of key things that I want to stress in these outputs is you can immediately see that the delayed transition means a much higher carbon price to be kind of well below 2 degrees by 2050 in the global case, and the same will be true in South Africa. So you can compare the difference of kind of $830 by 2050 in the global case over here to about $350 in the immediate 1.5 degree transition scenario. And I stress this because I think certainly from a kind of portfolio management perspective, this result is a little bit counterintuitive in that certainly from a short-term perspective, we would think that no policy action, in the short term would lower transition risk. But actually, if you assess NPV between now and 2050, it is worse for the bottom line to kind of delay action. And that is reflected kind of quite neatly in how we think about direct carbon costs and how we've modeled it. And just to kind of give you how this, a sense of kind of like how this, compares to the global prices. we've just kind of like included a sort of short snapshot to 2030 to kind of give you the immediate term impact. And this is for the delayed 2-degree transition. And you can see that kind of on the left-hand side, you can see our assumed convergence with global pathways happens after 2030, because we don't have any, we have a stated policy ambition to 2030, but nothing afterwards. You can also on the right-hand side just see how the global prices evolve and what the difference between the different scenarios are. And again, my speaker view is kind of blocking the left, but you can see that for an immediate kind of 1.5-degree transition, there is an immediate steeper increase now, but in the longer term, it will require a kind of much more significant increase to be net zero, or rather kind of well below 2 degrees. Now, just to wrap up this section, and then I'm going to kind of give everyone a short break. How do we think about kind of choosing these, how do we think about choosing climate scenarios for the South African context, and when and where should we be doing customization of these variables? I think the kind of key takeaway is that the chosen scenarios that we use must make considerations for South Africa, but also reflect broader transition risks, broader global transition risks rather, because South Africa is a kind of smaller player on global markets. And we have kind of, for the purposes of this project, chosen what we think is a happy medium in that we use largely kind of global Africa-specific outputs in the Planimetrics exercise, which I will talk about a little bit later, but also have a kind of bespoke modeling approach for direct carbon costs in South Africa. That is what we think is a valiant and kind of realistic attempt at sort of forecasting what the policy mix is going to be. Now, I think it's just worth emphasizing before we break that I think, future work in the space there's kind of much potential for future work in the space, and that could take many forms. It could kind of be a kind of slightly more, sophisticated way of modeling kind of global, sort of the local carbon prices, but also kind of take into consideration physical risk, which we haven't done in this project. And of course, a sort of comprehensive and internally consistent set of scenarios for South Africa specifically would help this exercise and would certainly aid the kind of transition risk assessment exercise for the local operations of firms in South Africa. And indeed, we understand that there is some work underway in the space, and we would love to kind of be involved in work in that for the future. So I think what I'll do over here is we're a little bit behind schedule, and I do want to the next section I think is the most important section in the workshop. So I had originally budgeted a 15-minute coffee break. I'm going to be a real pain and ask that we restrict this to 5 minutes, if that's okay. So by my watch, or we can do 8 minutes rather. So by my watch, it is just after 20 to 3. And I would like us to kind of start again at 10 to 3, if that's okay. So thank you very much for kind of for listening and for your participation over the first kind of 3 sections. Go and kind of stretch your legs and have a coffee break, and I'll see everybody back here in about 8 minutes, if that's okay. Hi everyone. I hope you managed to kind of get a coffee and stretch your legs. I'll give everyone another minute, and then I will start the session. All right. I think if people are still sort of grabbing coffee, they can join. I'm gonna get started with the second half of the workshop. So I think this is the bit of the workshop that I'm the most excited about, and I think is also hopefully going to be the most useful to you and your colleagues. And what I want to do, what we're doing here is to kind of talk through how you can use the outputs from these scenarios as practical tools in a transition risk analysis that can inform a disclosure. And we're hoping to keep this as practically oriented as possible. Sorry, my computer froze, but I'm back. And some of the themes that we're going to cover are what the kind of core drivers of transition risk are at different time horizons, and how you can use off-the-shelf outputs with minimal data collection and modeling capability to kind of test portfolio risk in a very meaningful way. And this is kind of how we would inform getting started on the scenario analysis journey. And we'll conclude this section with a tentative roadmap to best practice. So, where we are currently, what's required to get started, and how you can get to the kind of international gold standard. I do unfortunately have to stress that all the examples here are completely illustrative. And what we'll be doing in this section is going through worked examples of how to assign a qualitative risk metrics to kind of key sectors in a portfolio. I have to ask you to kind of please not replicate these or rely on them in any way. It's just for illustrative purposes. But my hope is that we can use the insights gained from the methodologies presented here to help you and your constituents get started on this journey. The other kind of caveat that I just want to make before we get stuck in is that what I'm presenting here is only one example, but it is not a one-size-fits-all approach for any portfolio. And in fact, kind of any portfolio transition risk exercise requires some kind of customized analysis. And there are various initial stumbling blocks that might cause what I'm presenting here not to be perfect for you. The first is that, and I'll come to this in a second, but what we found in our work is that a lot of financial institutions, when assessing their investments, use very different systems for classifying their investments into different sectors. And as we'll see in a second, there is some degree of arbitrariness to kind of how these systems work. And what you and your portfolio managers use is an internal decision that will to some extent inform how you go about this analysis. So it's important to kind of bear that in mind. And I think more importantly, what you'll see in a second is that we will be using kind of 3 illustrative variables from the scenario outputs to show our methodology. But those 3 variables may not be the most important ones from the scenarios for you. And it's important when you do this exercise to have a kind of considered view of what in the scenario outputs you think is the most important driver of risk in your business. And we'll circulate these slides. After the workshop. But as you'll recall in the beginning of the workshop, there's a kind of breakdown of the kind of variables that you can extract from climate scenarios. And that'll give you a flavor of what you could get out of, say, NGFS or IEA if you did this exercise yourself. And finally, you'll see that in the 2 worked examples I'm going to go through now, what we recommend instead of a full quantification of transition risk is assigning qualitative risk bands. And I just want to stress that how you do these risk bands and what you choose as high, medium, low in terms of transition risk is a fundamentally subjective decision. And that depends on your business and the risk profile that you kind of consider for your investments. And so we've presented a particular kind of way to do it over here, but that is not necessarily the correct way. And you should rather rely on your kind of own expertise and assessment of risk than take our kind of suggestion for how to classify these risk bands. Now, before we start, I think it's worth talking through the ways that transition risk can kind of feed into an overall impact on your bottom line as a financer of economic activity. And there are 5 key channels that transition risk feeds into a portfolio's overall value. And you can see that these are disaggregated into 2 main categories, changes in costs and changes in demand. And on the far left-hand side, you can see we have direct carbon costs. And we've spoken quite a lot about that. So that'll be the result of carbon taxes or other ways to tax emissions. And within changes in cost, you have things like abatement savings. So that's if the sector can adapt to climate change, what savings are possible by substitution of, say, new technologies or changes in production techniques, and market structure impacts. And what we mean over there is essentially a nested term for various things that include how the market responds to transition risk or changes associated with climate policy. And that includes competitive effects, so firm entry and exit, but also things like the extent to which firms are able to pass on cost increases to consumers. And as I'll kind of mention later, the Planetrix model incorporates these dynamics into how they quantify transition risk. And then on the right-hand side, we have kind of changes in demand. And intuitively, that can be split up into kind of demand creation and demand destruction. And I think these two terms are very intuitive. An example of demand destruction would be if you are heavily invested in coal mines, there's probably going to be low demand for that as we phase out coal power. But conversely, if you're heavily invested in an input into electric vehicles, there will probably be more demand for that product as the low carbon transition progresses. Now, I want to kind of get us started with another poll just to kind of keep everybody on their toes. Before we get into kind of how you use these obstacles, so how you use these scenario outputs, I'm interested to kind of hear from participants in the room, what is the biggest obstacle for your business or your portfolios to disclosing transition risk metrics at the sectoral level? And we've put a couple of options in here. So we put kind of data availability, we put lack of knowledge on methodologies and sort of policy uncertainty. And then we've also put a kind of more optimistic one where there are no barriers and you're already doing it. And I want to sort of hear from participants what you feel the most significant barrier to you is. So I'll give everybody a minute to respond. Please, there's obviously not one right answer, so please do kind of think through your responses and I'll circle back in a minute. So can we show the responses? So I can see on my screen that more than half of participants flag lack of knowledge on applicable methodologies as the most important obstacle. And I'm very pleased that's the case, because hopefully what I'm about to show you now will help address those shortages, that obstacle to some extent. Now, I want to kind of give a brief overview of our approach that we're using. And I think the key takeaway is that qualitative assessments of transition risk by sector, so by a kind of sectoral exposure in your portfolio, are possible using freely available scenario data and minimal modeling capacity. And I know I'm repeating myself here, but just to kind of emphasize that advanced methods for quantifying transition risk are not necessary to kind of begin the disclosure journey. And key variables related to kind of how transition risk impacts on your portfolio can be extracted using off-the-shelf outputs. Now, we are going to go through some worked examples below using the 3 variables you can see on the screen to stress test a portfolio with respect to transition risk. And we're focusing on 3 variables. We're focusing on carbon price forecasts, on changes in the energy mix, and on demand forecasts for key technologies. And as you'll see in the examples, what we've chosen as the relevant technologies is electric vehicles, but you don't have to choose that. The scenarios will give you many technologies. And to kind of stress again, these outputs are not exhaustive. So how you use the scenario outputs is fundamentally a subjective decision dependent on your own portfolio. So please don't take this as an exhaustive list. But hopefully what we will get out of this session is a practical introduction into how you might use the outputs. Now, this slide is potentially kind of more daunting than it seems, but what we're proposing in the UK Pact project are 3 different approaches to assessing transition risk by sector. And they kind of, as you kind of go down the screen, they increase in granularity and accuracy. And what we're going to do now is talk through worked examples of approach 1 and 2. Approach 3, we are going to kind of reserve for the discussion on the Planetrix outputs, which is an example of approach 3. Now, what approach 1 basically involves is extracting overarching narratives from the scenario data that inform a purely qualitative risk disclosure. And all you require as an input into this analysis are key scenario outputs that are relevant to your portfolio, such as carbon prices and the energy mix, as well as your portfolio exposure by sector. Now, the outputs of this analysis will be qualitative risk rankings by sector, such as low, medium, and high, and also by time horizon. Now, this approach has the advantage of being low cost in terms of modeling capacity and time, and is also achievable using entirely public data. And I do want to stress that. Now, of course, the disadvantages of this approach is that what it won't give you is a quantification in NPV terms of what the portfolio impacts are. And it does allow for quite minimal variation between sectors. And it's important to kind of stress that, between and within high-level sectors. And what I mean by that is, take, for instance, something like the mining sector. It will allow us to kind of form a qualitative assessment of which mining sectors will benefit from the green transition. but overall will assign a kind of overall risk metric to kind of, say your mining portfolio, rather than distinguishing separately between different types of mining. Then what approach 2 does is very similar to approach 1, but the only difference is that it involves targeted customization of key scenario outputs. And this links to what we've done with the South African carbon price. And approach 2 is a 2-step approach. It first involves choosing what variables to customize to the local context, and using those to kind of inform some kind of quantitative calculation relevant to transition risk. And what we're suggesting here as an approach 2 example is quantifying direct carbon costs based on the scenario forecasts. But the second step of this analysis is using those quantified costs as a base to then be adjusted based on the other themes in the scenario. So the second step would involve using your estimate of direct carbon costs into the future, and then asking yourself, does the scenario say anything about changes in the energy mix or key technologies? And should my assessment of transition risk be adjusted based on what those other variables say? And the output of that analysis is also a qualitative output, a high, medium, and low, or even very high, very low assessment of how your transition risk will vary at different time horizons. But it has the advantage of a more rigorous quantitative underpinning, using direct carbon costs, or indeed whichever variable you want to use to quantify an aspect of your transition risk. And finally, what approach 3 involves is using an internally consistent climate risk model to quantify NPV impacts associated with transition risk, and to decompose these impacts into different channels. And I'm going to not say too much about this now, because I'm going to reserve this until the end of the session when we discuss the Planetrix results, which is an example of approach 3. But I will say that the sort of drawback of this approach is that it is more time intensive and costly, and is potentially something that stakeholders in South Africa should expect to do in a few years rather than right now. Now, just to give you a flavor of what the outputs of approaches 1 and 2 look like, these are qualitative assessments of risk at high-level sectors. And you can see an example of what a disclosure in the space might look like. And what we've done over here is taken our representative portfolio and reported the high-level sectoral exposures and a kind of indicative assessment of what transition risk might be at different time horizons. Now, I should again stress that these are strictly illustrative and is not something that you should replicate in a disclosure. But you can see that what the kind of ask is here is not a detailed calculation. It is a considered assessment of how you think your portfolio will evolve at different time horizons. There's an important point I want to make here, in that what Planetrix use in their assessment is a sectoral classification called RIBIX, which a lot of international financial institutions use. I want to emphasize again that there unfortunately isn't consistency between sectoral definitions across FIs. And I also want to make another point that in order to report in this way, you need your sectoral definition to be MISI, so mutually exclusive and collectively exhaustive. And what that means in practice is that firms with operations in potentially kind of multiple sectors in these classifications will necessarily be classified into one. And why that's relevant is that for things like kind of mining and energy, there is of course significant crossover between those two sectors. And you'll find that for the purposes of these exercises, a company like Glencore, who supply a lot of the coal to be used in coal-powered power stations, will be classified under RIBIX as energy, even though they, of course, could be classified as non-energy materials as well. So that's just to kind of stress that the sectoral definitions that you use and that we're using will always require a bit of clarification and are to some extent subjective. And we are going to go through worked examples of how to kind of do this exercise both for energy and the non-energy materials sector using approaches 1 and 2 right now. This is actually a very good question from Maria. So Maria's posted in chat, is the exposure share static in the model, or is there ability to vary this within one scenario? That is a very good question. And how we've done it how we normally see financial institutions report in this space is to assess their risks on a static basis. So normally a kind of year-end financial year basis, and to assess how given those exposed they are. It is theoretically possible to kind of embed some kind of portfolio change over time in the scenario analysis. But the reason why we don't typically see that done is because the scenario analysis itself will inform the kind of strategic reallocation between sectors. So to some extent, for the purposes of reporting, that's putting the cart before the horse, in that the portfolio share is dependent on the kind of transition risk exposure. So although, of course, FIs will respond to kind of these risk metrics and reallocate their portfolios accordingly, that will largely be informed by the transition risk analysis. So that's why we've done it in these slides on a static basis. Now, what I'm going to do now is talk through a worked example of the first approach. And I don't want, the next slide is going to have a lot of detail. So I don't want kind of people to sort of be intimidated or sort of switch off by what's on here, because we're going to go through this step by step and you'll have these slides afterwards. Now, as I said before, the first approach is purely qualitative and focused on sort of largely extracting the key themes from what the scenarios give you. And the way this approach works is in 3 steps. The first step is to form a qualitative viewpoint about key scenario outputs. And as I said before, we'll be focusing on 3 of these: the carbon price, the energy mix, and key technologies. And what I mean by qualitative viewpoint is just the kind of assessment of how these things evolve. And take, for example, the carbon price. Such a qualitative viewpoint might be something like carbon prices are immaterial by 2035, followed by steep increases to converge to the global price. That's an example of what such a qualitative viewpoint might be. And on the right-hand side, I've emphasized again that these variables are, of course, portfolio dependent, but you can also freely extract these from the NGFS Scenario Explorer. So there is a hyperlink in these slides, which will be circulated, and you can download these forecasts yourself and look at the scenario data yourselves. The next step is to translate these themes into impacts onto sectors in your portfolio. And I'm going to talk through kind of like examples of what this might look like. So for instance, for the carbon price, the impact might be something like after 25, direct carbon costs will increasingly be material to the mining sector's bottom line. That's what we mean by a kind of qualitative impact. And I see there's a typo in there, apologies, increasingly be material. And similarly for the energy mix, such a qualitative impact might be something like coal mining investments are at very high risk after 2030. That's what we mean by kind of forming such a viewpoint. And in terms of key technologies, you'll see in the example coming up that we're considering electric vehicles, but the ones you choose to consider depend very heavily on your portfolio. And then finally, the third step is to assign different transition risk metrics at different time horizons, taking into account all 3 of the things that we're considering, or indeed, if you want to consider more, all of the others that you are considering. And so you might, for instance, in the short term between 2021 and 2030, come to a conclusion that there are minimal carbon price increases and no short-run energy disruptions, and so your overall score might be low. You can already see from the way that I'm talking that this is a very subjective exercise, and this is much more about extracting the narratives from the scenario than it is quantifying anything. And I'm going to now talk through how we might do this in practice for what Rubix will call the non-energy material sector, but is actually what we would understand as the mining sector. Now, you can see that sort of key themes drawn from the scenario outputs inform your qualitative assessment of transition risk. And we've included trajectories of sort of the key themes that we're talking about here for you to look at visually. So on the left-hand side, you can see how the carbon prices evolve under this scenario. And because the first approach does not require any customization, these are global prices. I want to stress this. And on the right-hand side, you can see what the key takeaways from the trajectories are and what the implications are for the non-energy materials sector, just in a very general sense. So let's take a kind of closer look at carbon prices. You can see that the graph shows steadily increasing carbon prices to 2050. And what this will mean is a consistent and rising impact on high emission sectors in terms of the bottom line. Now, what does this mean for the mining sector? Well, we know qualitatively that emissions, that the mining sector in South Africa is a large generator of the country's emissions, just because of how energy intensive it is. And it therefore has a very high exposure to direct carbon costs. So this is the general narrative that you can draw from the carbon price. And we'll see on the next slide how to apply this to different time horizons. Let's now look at the energy mix. What you can extract the full energy mix prediction from the NGFS scenarios, but just focusing on coal power capacity, the takeaway is clear. By 2035, in the immediate 1.5 degree scenario, there is a near total phase out of coal. And by 2040, it's basically almost phase out. Now, thinking this through again, what does this mean for the mining sector exposure in this indicative portfolio? Put bluntly, it just means that direct changes in the energy mix are a direct going concern risk to coal mines. And so if you're invested in portfolios that are heavily exposed to coal, this change in the energy mix is a big deal. And what this also means as a kind of secondary consequence is because there needs to be a very accelerated transition away from coal to meet the 1.5 degree goal in the scenario. There is also a secondary risk of short-run energy disruptions as a consequence of that phase-out, which may also affect the bottom line of an energy-intensive business. And finally, what can we draw from themes in key technologies from this scenario? Now, what you see in the bottom is a forecast of EV demand extracted from the NGFS scenarios. I think it's worth clarifying. It's worth clarifying briefly over here that the NGFS scenarios don't give you EV numbers, although other scenarios do. But what they do give you is electricity demand for consumer and business-driven like transport sector. And you can use those as a proxy to kind of construct EV demand, because obviously electric and hybrid vehicles are going to be the ones consuming that electricity. And you can see the graph in the bottom left-hand corner gives an indexed version of that demand. And we can talk through kind of like what the key kind of takeaways are for this. So for hybrid vehicles, some of the PGMs, so the platinum group metals, are used for kind of catalytic converters. And things like lithium and coal, things like lithium and cobalt are used as battery inputs for electric vehicles. So there is some possible upside for these sectors. What's important to kind of assess is whether these upsides are outweighed by the other downsides that you see. Now let's talk through how you can use these to assign risk scores at different time horizons. There is a lot on this slide, and I'm not going to be able to kind of go through anything. But I think what I want to do is focus on the short term just for now, just so we can kind of get a flavor of how you might use these outputs to assign risk. And essentially what's going on over here is for each of these key themes, we are assigning a qualitative risk metric step by step. And then at the bottom, we're trying to draw all of these threads together to assign an overall risk metric for the sector. So if we look at the short term, what do carbon prices tell us? They tell us that there is a steady increase in carbon prices, and that by 2030, if you follow the global scenario, the carbon prices will increase to $50. What does this mean for an emissions intensive sector? Well, who can tell? But that kind of, that increase is certainly material. It's not something to kind of be sniffed at. And so we've assigned over here a medium score. But as I said, this is fundamentally subjective. Now let's move on to the kind of energy mix. What does the phase out of coal mean for the mining sector under this scenario? Well, obviously it means demand construction in coal mining and coal-fired power, but it also means possible disruption to energy supply in those sectors as coal power is phased out. And so because of those possible disruptions, we've actually in the short term assigned a high risk, given the kind of relatively rapid phase out of coal. And finally, what trends can be drawn from key technologies that are relevant to mining? Well, we have certainly from the NGFS outputs, relatively slow uptake in electric vehicles before 2030. And this will give a very, very kind of limited boost for sectors that are involved in the metals relevant to electric vehicles. And certainly the overall kind of, you know, risk over here is obviously kind of very low. And I think I realized that I think maybe we should have kind of changed some of the terminology in these slides. I think perhaps a sort of better way to kind of think about it rather than terming it risk is terming it impact, because something like this might have a kind of higher impact, a higher impact kind of further along the line. It's just a positive impact rather than a negative impact. And now you can see in the short term how we've drawn all of these themes together, and we've put a kind of brief summary of what this means. In the short run, opportunities from technology are limited, and you can kind of see over here that although carbon costs are lower in the short term, there is specifically for coal mining a risk of energy supply disruption, specifically for coal mining, a direct demand shock and an overall risk of energy supply disruption. And so we've decided to kind of assign this sector medium risk in the short term, balancing all of those two things together. And you can probably, as you can read on the slide, we've gone through a kind of similar exercise for the other time periods to kind of arrive at a much higher risk score for transition risk, largely because direct carbon costs and the coal phase out will fundamentally impact the bottom line. And we don't think just by inspection, the opportunities from key technologies are going to offset this, given how emissions intensive the mining sector is, although it's worth disclosing that there are opportunities to be made there. Now, we've repeated this analysis for another scenario that we're using in this exercise, which is the delayed 2-degree scenario. And I'm certainly not going to go through this in as much detail, but I just want to kind of flag some of the differences in this scenario to the one we just looked at. You can see on carbon prices, there is a very, very limited, if any, response in direct carbon costs before 2030. And again, I want to stress that these are global prices. Whereas after 2030, there is a rapid increase to a much higher level to compensate for the delay, much more so than there is in the immediate 2-degree scenario. And focusing on coal power capacity, you can see that in the delayed transition, there is actually an increase in coal power generation before 2030, followed by a decrease. And you can see immediately that this will impact on the risk metric that you assign to the short term, given the delay, but will result in potentially even higher risk metrics in the longer term based on the delay. And you can see how this is applied in practice. Essentially, in the short term, there's very low risks just because the transition is delayed. However, in the longer term, precisely because of this delay, you can see that the scenarios quite clearly show that the sector is at much higher transition risk because of rapidly increasing carbon costs and a potentially very disruptive shift away from coal power. And this is reflected in the risk scores that we've assigned for both the medium term and the long term. So you can see, unlike in the immediate 1.5 degree scenario, we've assigned high risk to the medium term and very high risk to the long term, precisely because of the disruption associated with a delayed transition. And finally, just in terms of how you would present the outputs of, the first approach, one of the intuitive ways that we've seen this done from other financial institutions is to present a heat map in the TCFD disclosure. And this gives you a sense of how such a heat map might look for a purely qualitative disclosure based on off-the-shelf outputs. And already, I want to stress that nothing that I kind of just described to you is particularly sophisticated. It's very intuitive and is based entirely on off-the-shelf outputs. But what you see over here is already significantly more comprehensive in terms of detail than what is out there in the South African market. And I think that the key takeaway is that there is already the capacity to take the outputs of these scenarios using approach 1 and inform a purely qualitative disclosure that is analytically meaningful in this format. Now, I had to rush through that a little bit, but before I move on to the second approach, I'd like to stop for questions here, or even just kind of reflections. If anyone would like to kind of comment on, how I've kind of, articulated this approach, and maybe offer some initial reflections on, whether this is intuitive and whether you think this output is useful. I think I might kind of leave it on this slide, as this is the kind of starting point. If there are any questions, please feel free to post them on the chat or raise your hand.
Raphael, can I talk? You're muted. Okay.
I think it does that automatically.
Okay.
Apologies. Yeah.
Just these three themes you've chosen, yeah, very appropriate. I agree. One thing that's very important in South Africa, and I'm helping a couple of companies at present with scenarios, climate scenarios, and that's the socioeconomic impact. And they're all quite adamant that that aspect as a theme is up with the more, what you might call techie ones, the more physically quantifiable ones. It's just a comment.
Sorry, I muted you while trying to unmute myself. I'm clearly not very good at this, but thank you. I think that is a very important comment, and I think our sort of group is quite concerned to incorporate the just transition into all of these analyses. I think it's just worth emphasizing that we aren't advocating this to the exclusion of just transition considerations. All we're showing here is how you would go about thinking about transition risk in relative isolation. But I think you certainly raise a good point. And in the disclosure, particularly if you're heavily invested in coal, this is definitely something that you would have to consider. I see that there is a question from Tabiso on the thread. It says, on that note, how applicable are the SSPs? You're going to have to excuse my ignorance. I actually don't know what the acronym refers to, SSPs. I'm sure somebody else does, and apologies for betraying my ignorance on this. But I assume it means kind of how appropriate would these be sort of given just transition considerations. Yeah, and just a kind of follow-up comment from Dave that these are much more difficult to quantify. I think that these give a kind of good assessment of the bottom line, notwithstanding. What it can't do is give an assessment of, say, the internal governance and policies that you as a funder need to manage the just transition. And I think that's something that in the TCFD disclosure would go in the kind of governance section of the disclosure, which we aren't really touching on, but which we will be focusing on in other outputs of the Pact work. And I see Brent has his hand up, so I'm going to ask him to opine on that a little bit. If you could unmute Brent, that would be good.
Hi, Raf. Yeah, no, thank you for that. No, that's definitely an area we're trying to focus on going forward. Is the just transition in TCFD disclosures. I think when just to get back to Dave's point, I think it's very important to do. It does make your modeling a lot more complicated if you also including socioeconomic variables, because then you end up back at the integrated assessment model kind of world, which is a step up in complexity, even above your third tier, which you're going to tell us about but later on. People have started doing this. I mean, you can apply the same kind of qualitative knowledge or qualitative approach that Raf is advocating here in tier 1. I mean, that's what we did a couple of years ago. We did some work for the Department of Forestry, Fisheries and Environment, looking at greenhouse gas pathways for South Africa. And we ended up with, I think it was 3 broad pathways. And the mitigation modeling was quite sophisticated, but in terms of the socioeconomic modeling, we did this kind of thought exercise, where we ended up with the 3 pathways. We looked at the big changes in those pathways, and we used that to make some wild assumptions about things like employment, inequality, and things like that. So you can compare these approaches. I think from a disclosure perspective, I think it's more important to focus on the company's, your institution's actions. So if you are rebalancing your portfolio based on this analysis, what does that mean in terms of your general social impact? What does that mean in terms of jobs? Are you expecting to create more jobs through funding renewable energy than from divesting from coal or things like that? So I think there are 2 elements there, but I think it's you rightly flagged as a very important issue. Climate Action 100, for example, and they've got some climate metrics that they use to assess, companies' commitment to a net zero transition, and they've got a placeholder in there for socioeconomic impact at this stage. So it's something that's coming, and currently, I think we've seen. I don't want to lie now. I think it might have been FirstRand, or we've seen one South African company that in their TCFD report explicitly mentioned the just transition, and that's the only one. And there might be more. So apologies if some of the institutions represented here have done that and we haven't picked up on it. But we've only seen one doing it. But we definitely see this as a trend going forward. So, and we're hoping to focus on that, as this project goes forward. And in our toolkit that we're going to be preparing, there is going to be a short note on this, with our views and our thoughts on this. But we're not at the point yet of integrating it into the approach, like Raph is suggesting. But as I say, I can easily see how you could add a qualitative layer of, to add that to scenarios. And then in time, if there's sufficient budget, the models exist, you need an integrated assessment model, but it's a thing that's doable. Thank you, Raph.
I think maybe just something kind of quick to add to that. I think I think there is an argument to be made, certainly for the kind of purely financial impact for getting started as quickly as possible, which is what we're trying to advocate over here. Whereas I think something like the just transition should be done kind of more rigorously and with kind of potentially kind of greater research into the impacts of your portfolio rebalancing than just off-the-shelf scenario outputs. And I think what we wouldn't want is for that to kind of hold up disclosures entirely, but we would want it to kind of be done properly and in a considered way. I'm really sorry to rush us along. I'm just kind of conscious of time, and I want to go through the second approach. So what approach 2 does is use a quantitative base to inform qualitative outputs. And the sort of overall approach is that we're suggesting here is to use qualitative risk bands based on direct carbon costs, to calculate direct carbon costs and use these to inform qualitative risk bands, which are then adjusted using other themes in the scenario. And because this is a step up from approach 1, it's a little bit more data intensive. So it does require some data collection, but it's relatively minimal. And some of the data that would be necessary to collect is firstly emissions data, and secondly earnings data from clients, so EBITDA, or you can use revenue as a proxy as well. And finally, although the third point is not strictly necessary, some kind of indication of how your client's turnover varies between different products. And I'll explain why we need that a little bit later on. Now, I think what I'll show in a second is using client emissions data. And I should just add briefly over here that certainly for listed equities, it's quite easy to source that data from third-party databases, such as Trucost and ISS ESG, and there are links to those in the slides. It is possible to have a stab at quantifying direct carbon costs using emissions data and earnings data from your clients. And I'll explain how that's done later on. And those are used to kind of form the basis of the qualitative risk bands that would inform a disclosure using approach 2. And finally, the kind of third step would be to adjust those risk bands based on the other outputs of the scenario. And we're going to do a worked example now using what Rubix will classify as the energy sector. But we specifically picked this example, firstly, because it's very emissions intensive, obviously, but secondly, because in the indicative portfolio we're using, there are actually only 2 companies in it. And so collecting the data is relatively straightforward. Now, as I said before, approach 2 requires a little bit of manual data collection, although nothing too intense. And fortunately, in our illustrative portfolio, there are only 2 companies that would be classified in Rubix terms as energy. Bearing in mind the limitations of these, of these sectoral definitions, there are only 2 of these companies. And we can, from entirely public sources, source both their emissions and their earnings. And so you can see just from either their annual reports or their sustainability reports, you can get their scope 1, so their direct emissions, or their scope 2 emissions, so operations from energy. And these are from kind of purely public sources, and you can see that we've summed these to kind of give a total of the scope 1 emissions in this sector in the portfolio. And by the same token, we've done the same things for adjusted earnings, which we'll see in a second will be used to kind of quantify the importance of direct carbon costs. And finally, the last aspect of this approach that we are advocating is to do a deep dive into kind of what your clients are producing and how their revenues are split between different products. And this is to allow a little bit more of a kind of granular assessment of risks and opportunities than we can get in approach 1. And you can see that also from public disclosures, some information is offered on this. So you can see that Glencore give a breakdown of both their energy and metals exposure. And you can see that Exxaro give a breakdown of specifically coal, which is the vast majority of their operations, and energy operations and and iron as well. Now, of course, for larger portfolios, you would have to repeat this exercise across clients. But fortunately for listed equity, a lot of this information is available in third-party databases as well. And in the kind of best practice TCFD disclosure will include an indicative list of third-party data sources you can use for this. Sorry, my slide is not moving. Now, I think the key insight of this approach is that with this minimal information, you can use forecasts of direct carbon costs to actually quantify the exposure of this sector of your portfolio to direct carbon costs. And as I mentioned before, we have modeled this for the Pact exercise, although it's not strictly necessary to model it. You can use global outputs, and you can see the modeled outputs, just to kind of refresh your memory, on the left-hand side. And all that is required to quantify the direct carbon costs is a simple estimation methodology of earnings at risk. And that is a relatively kind of straightforward process. All it requires is estimating the total earnings of your clients in the sector and their total emissions. And you can use their current emissions as a base for forecasting the future exposure of that company to direct carbon costs. Now, there are obvious limitations to this in that, of course, their emissions might change every year, and this doesn't take into account the evolution of technologies in the sector. But what it does do is offer a more rigorous quantitative underpinning for assessing transition risk in a given sector. And you can see in the bottom right-hand side, what in this scenario, and for this particular portfolio, you can see in absolute terms how direct carbon costs will evolve for the portfolio and what proportion of total earnings this represents for the companies in the portfolio. And now the next part of this analysis is relatively straightforward. The first step is to choose qualitative bands based on the value at risk from direct carbon costs. And we've suggested particular bands over here, but as I said, these are fundamentally subjective and will change depending on your business and portfolio and what you think is the most important. And these are assigned as a kind of preliminary sort of assessment of how transition risk impacts the sector in the portfolio. The final step is to then take these preliminary bands and look at the other scenario outputs and ask, does the output of the scenario suggest that the bands need some kind of adjustment? And how you do this is kind of relatively familiar. So we've got on the kind of right-hand side, coal power capacity, and you can see that in terms of direct carbon costs, the impact is pretty low. But because there's a gradual phase out of coal, and because this portfolio has significant coal operations, we recommend adjusting this upwards to medium in the short term to take account of that. And you can see that in the medium term, we've taken a similar approach, that because of how important coal is specifically to Exxaro, we adjust our risk metric from medium to high. And because by 2041, coal is completely phased out and there are limited opportunities from technology for these particular companies, we don't make any adjustment to the risk level. And that's how we arrive at the risk bands using approach 2 for this sector in the portfolio. Now, we've included exactly the same analysis for delayed 2-degree transition as well. Because I want to show what the Planetrix outputs look like, I'm not going to go through this. The only kind of really important point that I did want to make is to drive home the difference in direct carbon costs with the delayed transition. So you can see, so you can see over here that in the first scenario, the kind of ceiling for direct carbon costs was above 35%, whereas in the delayed transition, it's more than 100%. So it just means that the kind of difference purely in direct carbon costs with the delayed transition in order to maintain a well below 2 degrees is very, very significant. And finally, this question is a bit cheeky of me, but I wanted to kind of, you know, based on what I've just described here in terms of how you use these practically, given a delayed 2-degree scenario. So I'm going to kind of flash this up on the screen as well. No need to kind of think this through significantly, but I want to know kind of for your portfolio, so the investments that you manage, or indeed the business that you're in charge of, how would you rate your own exposure to transition risk? And I'll give people an opportunity to kind of reply just for about a minute, and then we'll move on. And the responses are still coming in, but Sefako, if you could show the screen, or it might be showing already, I'm not sure. But you can see that half of the responses thus far have taken a kind of, you know, indicative suggestion that there is a high exposure to transition risk, which I think in overall terms is probably right for the South African economy, given the energy system in the country. And just quickly before we move on to the Planetrix outputs, what we put over here is something of a kind of indicative roadmap into kind of, you know, how you progress from approach 1 to 3. And I think the truth is that the first approach, which is purely qualitative, people can start with right now. And my hope is that after we circulate these slides, they can assist in part with kind of getting people started on the disclosure journey using entirely off-the-shelf outputs. Now, for the second approach, we've suggested, you know, quite conservatively 2 years to report in that way. That's only because the data collection that you need on emissions and earnings is a little bit more time intensive, and either needs to be resourced internally or budget found internally for subscribing to third-party data feeds. But to be honest, this might be kind of too long, and it may be possible for people to get started on approach 2 as well in the short term. And finally, I think the sort of, you know, approach 3, which will be the Planetrix results that we discussed now, is potentially some way away. And I think it's probably realistic to say that a kind of detailed quantification of transition risk would require some internal budget for employing outside modeling experts, or alternatively staffing your organization internally to develop bespoke kind of climate-wide models that are relevant to South Africa. And I'm no expert in this, but I imagine that this is some way away. So we put kind of 3 to 5 years, but these timelines are kind of only indicative, as I said. And I think I'm really sorry that I keep kind of rushing us along, but that was the section that I thought, you know, might be the most important for this workshop, just the kind of practical introduction into how we use this. And before I go through what the Planetrix output looks like, I just wanted to stop to see if there are any questions or comments based on these. I think what I might do is just pull up some of the approach 2 explanation, just in case people want to refresh their memory. So if you do have any questions or comments, please either put them in the chat now or raise your hand. Otherwise we can move on to the concluding section. Looks to me like people are, I think we've potentially lost a few participants just because of the time, and it does look like people are keen to move on. So I will now kind of go through, yeah. Brent says, I suspect everyone is keen for the results. I'm now going to sort of go through what the Planetrix outputs are and what they look like. And the Planetrix model is an example of approach number 3. So it comes from a kind of economy-wide and sort of internally consistent climate model. And what the results give you is a quantification of how much transition risk will impact on the bottom line of the portfolio. And this is in net present value terms. So what we're presenting today is that essentially kind of value impairments between 2021 and 2050. Now, just to kind of be transparent, what we've assumed throughout is a discount rate of 7.75%, just so we can convert this into NPV terms, but this can be adjusted as a parameter if necessary. And what the planimetrics results give you are kind of more granular sectoral impacts and a comparator for how our representative portfolio compares to, say, a global equity index, or what the kind of global average would be. The model also incorporates other channels for transition risk that are not covered in approaches 1 and 2. And in particular, what I'm referring to here are market structure considerations and abatement. So that isn't really considered in the approaches that I just described, and this model does consider them. And again, just to sort of stress, these results are kind of strictly illustrative. And one kind of important point to make for South Africa is that the planimetrics infrastructure currently doesn't have platinum mining as a separate sector, so it has mining overall. And that's obviously worth bearing in mind, given the importance of platinum to the South African economy when you look through these results. Now, just to sort of give you a flavor of what best practice looks like, what we're kind of seeing more and more people do is present an overall estimate of how much their portfolio is at risk financially from physical and transition risk, and for this to be disaggregated into different channels. And these refer to the channels that I described earlier for physical and transition risk. And you can see over here that the planimetrics model actually disaggregates impacts into different physical risks, which we're not doing today, but also demand destruction, creation, and direct carbon costs, and the ones that I described earlier. And this is just to kind of give you a flavor of what the planimetrics infrastructure does. So it has as its starting point climate scenarios, as we do. But what it then does is estimate quantitatively the value impairments associated with both economic shocks as a result of transition pathways, and also physical shocks as a result of actual changes to the climate and how that impacts asset value streams. We are largely not considering the third aspect of the modeling infrastructure for this project, but there's potential to do so in the future. And what you get as an output of the model are actual impacts in numerical terms, and these can be produced either at the sectoral level or the portfolio level, or at a much more detailed kind of equity level as well. But we're just showing kind of sectoral and portfolio impacts for this project. This is just to kind of recap the scenarios that are used as inputs into the planimetrics modeling, just to refresh your memory. And finally, before we kind of show the results, it's just, this slide is just to emphasize that the kind of really important difference in direct carbon costs associated with each scenario that is used in the planimetrics modeling. And we've gone through this a few times, but just to kind of emphasize again that even using a bespoke South African carbon price, the impacts of a delayed transition means a much higher carbon price to be fed into the modeling. And this just gives you a kind of few more details into some of the other inputs that feed into the calculation of value at risk. And what the planimetrics model does is consider how demand for key drivers of the energy transition change over time. And you can see how these evolve under different scenarios and how these feed as impacts into the model. And no surprises that in everything except the current policy scenario, there is either a gradual or a delayed but sudden phase out of coal in the results. Now, before I kind of talk through what the results look like, one of the things we've produced as part of this project is a comparison of our illustrative portfolio to something akin to a global equity portfolio. So we asked ourselves the question, if you are the bog standard average investor in listed equity from around the world, what is your exposure likely to be sectorally? And we chose as a comparison one of the leading global equity indices, which comes from MSCI. So you can see it on the right. And one of the interesting takeaways from our representative portfolio, which controls a significant proportion of the JSE's market cap, I actually don't have the figure offhand, but it's most of it, is that our representative portfolio is much more exposed to climate sensitive sectors than the global average. And you can see on the left-hand side that non-energy materials, so you should read mining or energy, make up a much larger proportion of our representative portfolio than the MSCI index. And the kind of, the intuitive takeaway is that our portfolio is probably then quite heavily exposed to transition risks, which we will see in due course that it is. Now, just in terms of the headline portfolio results, what the numbers here show you are what the NPV impacts are in the different scenarios. And you can see that there is a significantly higher NPV impact for the whole portfolio in a delayed transition. And I can't kind of stress that enough, but it just means that a delayed transition scenario, both for policymakers, but also asset owners and asset managers, is not optimal from a financial perspective. In fact, over the long term, in terms of value at risk, it is worse than an immediate transition to kind of 1.5 degrees. And you can see that between 2021 and 2050, what the Planetrix outputs estimate is that close to 8% of the value of the portfolio is at risk purely from transition risk. So this doesn't even consider physical risk. You should, of course, bear in mind that because these values are discounted, if you considered the kind of value at risk in 2040 or 2050, it would probably be significantly higher. Now, in terms of kind of like how these channels are broken up. So I'm going to show several slides in this kind of format, but this provides a kind of intuitive way of breaking out the transition risk impacts into different channels. So on the left-hand side, you can see that's the kind of current valuation. So that's the sort of 100%, and you can see how you can see the sort of positive and negative impacts that our modeling has produced as a consequence of transition risk. And you can see a large role in the immediate 2-degree scenario for direct carbon costs, but also not insignificant upsides from abatement and also competition effects. And what competition really means is firm entry and exit. So it's kind of modeling over there. If some firms go out of business, would the companies in your portfolio, be more profitable? This is the sort of similar analysis for the immediate 1.5 degree scenario, and you can see that the kind of direct carbon costs in the short term are larger because discounting kind of offsets some of it in the longer term. And then you can see the kind of delayed, the delayed 2-degree scenario over here. You can see much higher direct carbon costs, as I said previously, and also a sort of significant role for demand destruction in driving value down. But also in the longer run, significant potential for kind of abatement from changes in technologies and a potential upside from competition as a consequence of firms exiting the market. So these are overall portfolio impacts. And just to kind of summarize what the key takeaways are for the portfolio, direct carbon costs, because of how energy intensive the portfolio, are the key driver. But again, to emphasize that the NPV impacts of the delayed transition are nearly double because of how much of an increase in carbon prices you need to be consistent with a below 2-degree scenario. And just to kind of tie the narrative together, as the carbon costs grow, the countervailing savings from both abatement and competition also grow. But this is never enough to offset the impact of those costs. Now, what I want to show now is how these impacts sort of differ between sectors. And what these results are for sort of the second level of the Rubik sector definition. So Rubik's has kind of 6 levels, and the high levels that I've been talking about previously are level 1. But what you can see over here is the level 2, which is the kind of more granular results. And it's no surprises to anybody that upstream energy and chemicals have a really significant value at risk as a consequence of transition risk because of how emissions intensive they are. And this is largely consistent across the scenarios. So you can see that in the immediate 2 degrees, it's very high at kind of 87% value at risk. The same is true of 1.5 degrees. And the delayed transition offsets that slightly, but does make it worse in other sectors. And just to kind of summarize some of the key takeaways here, the NPV impacts are largely concentrated in 4 sectors. So mainly upstream energy, but also chemicals and mining, and to a lesser extent, kind of heavy industry and manufacturing. Focusing a little bit on upstream energy, the impact is by far the most significant, and there are two reasons for this. The first is kind of the fact that decarbonization is often impossible, and where it is possible, it's very expensive and capital intensive. And then there is also a demand destruction effect, which is for how carbon heavy products, how demand for those products fall in those scenarios. I see there's a question from Daralo, which is about how NPV impacts compared to other markets if available. That's a very good question, and I'm going to refer you back to this slide over here. And the short answer, we haven't quantified the NPV impacts for the index in this exercise. But I can tell you, having done this for other clients, that for a global equity index, you would have smaller NPV impacts. And so our representative portfolio in South Africa is actually more exposed to transition risk because of how energy intensive listed companies in the country are. And that's a really important takeaway to kind of, drive home in this analysis. And I think this chart kind of shows that quite intuitively. Just quickly to kind of go into a little bit more detail. I know that kind of some people have to drop off because it's close to 5 o'clock. We've also included, specifically for energy and mining, the same disaggregation of what is driving the value at risk. And you can see that in the case of upstream energy, it's largely a demand destruction issue, where because of the direct carbon costs imposed on other sectors, demand for carbon intensive energy kind of plummets in almost all of the scenarios, as you can see over here. And then quickly for mining, in some sense, the reverse is true, is that the value at risk over here is very heavily driven from direct carbon costs, by direct carbon costs, because of how energy intensive, the sector is. And this finding is broadly consistent between scenarios, as you can see as we run through the slides. Now just to kind of tie this all together, what can we take away from the Pnetrix results? The first, to kind of state the obvious over here, is that investors in South African listed equity are subject to significant transition risks when we quantify them. And direct carbon costs are an important driver of these, regardless of how you cut the mustard in terms of how you measure this. And the fact that South Africa has high exposure to upstream energy and climate sensitive sectors relative to elsewhere in the world is a key driver of this high transition risk. The second takeaway is that delayed action means greater NPV impacts. And I think that conclusion can be a bit counterintuitive, but it really is important to stress that, because I think there is the potential to take like a short-termist line in terms of how we assess transition risk. And when you consider value at risk over many years, the delayed transition is actually more expensive, both for funders and for businesses. Then in terms of what we can take away overall from this workshop, I think as great as the Pnetrix results are, we shouldn't kind of think of best practice as a barrier to getting started on this journey. And we've hopefully presented two ways that you as a funder or a business owner can get started in TCFD reporting on transition risk using entirely off-the-shelf outputs. And then finally, just in terms of future work, I think it is true that South Africa's net zero transition and the kind of ability to plan for it would certainly be aided by tailored transition pathways. We shouldn't understate the extent to which global pathways are useful, but we certainly also welcome the efforts that are underway to produce South Africa-specific tools in this space. And that space is very fast moving. So hopefully in the next few years, there should be scope to do what we've suggested here with more South Africa-specific outputs. Now, I've been talking for a very long time, and my voice is going a little bit hoarse. But other than that, I just want to kind of thank everyone for participating and encourage you to complete the post-workshop survey, which has been shared on the chat. Please do. As Brent said, this process is fundamentally demand-driven, and we really do want to get a sense of how much we hit the mark in the survey, in this workshop, and whether it's helpful to you. So please do take a minute to fill it in. Other than that, I just want to thank everyone again for participating and open the floor to any comments or questions on the session, either in the chat or verbally if you have any. Thank you very much.
I thank you, Raph. I mean, that was fascinating. We can't wait to see the full set of results when it comes out. So yeah, so now I think this is fascinating, and I think been really showing the the two portfolios and comparing the two portfolios to me was really interesting, because I mean, I guess it's to be expected, but I mean, it just brings back the fact of exactly how vulnerable we are. And I mean, the thing to highlight is this results when done. This analysis, when done purely with off-the-shelf international information, is not going to look a lot different. So I just wanted to highlight the fact that, I mean, this is certainly the first time I've seen this done for South Africa. But likewise, I mean, international companies have access to these models. They have access to the same information that they can be doing. They are doing these assessments. So even though we've tried to customize to South Africa, and that's probably made your results more accurate. These same analysis is increasingly going to be done by international companies, and international investors, and therefore I think it's very important that South African institutions realize that and start taking action. Because I think really, what this shows to me is, I think there is definitely a risk, of capital flows to South Africa if we don't address this issue, kind of head on.
Yeah, Brent, no, that's a very good point. I just see Thabiso posted something in the chat. Can we unmute Thabiso so he can ask his question? Because I think it would be good to discuss this point. I think it's an important one. Sefako, can you unmute him? There we go.
Hi, Raphael. Thank you very much for the insightful session. I think I've got two questions in between. I think to Dave, yes, I'm in the insurance sector. I participate in the other forum done by Just Share, where I participate as a member there. But the questions that I have is, how does this essentially look for insurance companies? And maybe another aspect that I want to bring it there for insurance companies is that, especially short-term, I mean the short-term space, is that we typically, the long-term thinking, it's not something that is well appreciated and revered. As a result, one of the things that I'm thinking about, because I'm leading strategy and as well as climate change work in my company, is one of the things that I'm constantly thinking about is that how to bring this, make it of value, whilst you use scenarios, but you look at the short-term perspective as well, as much as you do introduce the long-term thinking. When I say short-term, I think anything between 1 and 5 years, for example. How would that look like from I'm not talking from using a business perspective, not necessarily for reporting on TCFD, but to bring about the take-up and the broader awareness and understanding within a business.
I'm so sorry, Thabiso. I did that again. I keep trying to unmute myself and then muting participants, but I think you finished your question. I think this is an excellent point, and I have kind of two initial reflections on it. I think the first is that it is certainly theoretically possible to apply a similar version of this analysis to the insurance sector. I think the only conceptual difference would be, instead of thinking about companies that you finance, it would be companies that you underwrite. But I think how we think about risk would be similar, because obviously, in fact, potentially even kind of more applicable to insurers, because you would use this risk to price your premiums. So I certainly think there's an important role. There's an important role for this kind of analysis for insurers. We haven't really focused on it for Pact, but I think the point you raised about the short term being key for insurers, is a very interesting one. And I think to some extent it makes this analysis, it makes this analysis easier to some extent, because we can go out on a limb regarding policy, particularly in the energy sector in South Africa, with much more confidence over the short term than we can in the long term. So I don't think the kind of conceptual approach that you would use would change very much, but you might have to kind of, not for kind of TCFD, but for internal use, adjust the kind of time horizons that you would use. The only other quick point that I wanted to make is that there is, I'm no expert in this, but my understanding is that in terms of how we think about, if we think about what we need for approach 2, which is assessing the emissions of companies in your portfolio, how we think about how the sort of sustainable finance world is quite advanced in terms of how we think about financed emissions for direct financing, whether loans or equity. It is quite in its infancy in terms of insurance. So this space is kind of evolving quite rapidly. So there isn't yet international best practice in terms of, say, you know, how much emissions are you underwriting as a risk provider, as a risk buyer. And so I only say that just to kind of emphasize that the insurance space is in its infancy, and I suspect things will change. But conceptually, I think from a risk exposure perspective, the analysis would be similar. I see Brent is saying we should wrap up now. I'm sorry, I've gone a little bit over time, but I think that was a very good question. And I'm sorry if anyone else had questions, but I think we should probably end the session now. Just to say that I will just to say that sorry, Maria, when you said contagion risk, I thought you were talking about people not attending our sessions. But just to say thank you very much again for attending the session. I've really appreciated everyone's participation. We will circulate these slides in the next couple of days to you and to people that couldn't attend. And just a reminder to please fill in the survey that was circulated on the chat. This is fundamentally demand-led, and we really do value your feedback. So thank you again, everyone, and have a wonderful evening. Brent, do you have if you have any sort of final remarks?
No, Raph, I just want to thank you. I mean, thank you very much. I think that was a smashing session, and I really enjoyed that, and I can't wait to get the get the outputs out. And yeah, so I just want to thank you for a great session, and again thank all our all our participants. And we only went 5 minutes over, so hopefully you'll come back next time for the advanced room. But yeah, thank you very much, and we look forward to seeing you again.
Brilliant. Thanks, everyone. Cheers.